In this module, we're going to use the Black-Scholes formula to compute the sensitivity of option prices to the underlying parameters. The underlying parameters include the underlying security price, the underlying volatility parameter sigma, as well as the time to maturity. We're going to focus on two of the so-called Greeks in this module: the delta of an option and the gamma of an option. The delta of an option is the sensitivity of the option price with respect to the price of the underlying security. The gamma is the sensitivity of the delta with respect to the price of the underlying security. So we're going to discuss the delta and gamma in this module and see how they behave as time to maturity changes and as the underlying security price changes as well. So recall the Black-Scholes formula for the price of a European call option with strike K and expiration capital T. It is given to us by this quantity here. D1 and D2 are given over here, and capital N refers to the cumulative distribution function of a standard normal random variable. R is the risk-free interest rate, C is the dividend yield, and the stock price ST is assumed to satisfy or follow geometric Brownian motion dynamics, where WT is a Brownian motion. The Greeks refer to the partial mathematical derivatives of a financial derivative security price with respect to the model parameters. So I emphasize here that we've got the word derivative appearing in two different contexts. Sometimes it refers to a security, a derivative security price, and sometimes it's going to refer to the mathematical derivative. So the Greeks are a very important part of derivatives. They're used an awful lot in industry. They refer, as I said here, to the partial mathematical derivatives of a financial derivative security price with respect to the model parameters. The first Greek we're going to consider is delta. The delta of an option is the partial derivative, again it's the partial mathematical derivative, of the option price with respect to the price of the underlying security. The delta measures the sensitivity of the option price to the price of the underlying security. And so the delta of a European call option price is given to us by this. It's delta C delta S. Now, given the Black-Scholes formula over here, we can easily calculate delta C delta S. It comes out to be e to the minus C times capital T times n of D1, where, if you recall, n is the cumulative distribution function for a standard normal random variable. Now, this follows from 5, but it actually requires a somewhat tedious calculation. If you just look at this expression, then it does indeed appear to be the case that delta C delta S is equal to e to the minus CT ND1. And indeed, that is what we have over here. But don't be fooled by this. Actually, there's a little bit more work involved, because D1 itself depends on S, and therefore D2, which appears over here, also depends on S. So in order to calculate delta C delta S, we actually have to take derivatives within this ND1 term and indeed within this ND2 term as well. If we do that, using the chain rule and so on, and then simplify everything down, it turns out that indeed we get delta C delta S is equal to just this expression here. The delta of a European put option is also easily calculated. One way to do this is to use put-call parity. So if you recall, put-call parity implies that P0, the initial price for a put option, is equal to C0 plus K e to the minus RT minus S0 e to the minus CT. And so therefore, delta P delta S is equal to delta C delta S minus e to the minus CT. So once we know the delta of a call option, which is given to us here, we can easily calculate the delta for European put option as well. It's given to us over here. So here in this figure, we have plotted the delta for a call option and a put option. So we've assumed, although it doesn't state it on the slide here, that the strike is K equal to 100. The first thing to note is that the call delta is always between 0 and 1, and the delta of a put is always between minus 1 and 0. Now, if you think about it, this makes sense, because the payoff for a call option, so for a call, the payoff at time t is equal to the maximum of st minus k and 0, and the payoff for a put option at time t is equal to the maximum of k minus st and 0. So a call price, a call option, the value of a call option clearly increases as S increases. And that's why the delta of a call option is greater than 0. Similarly, the value of a put option will increase as S decreases, and that's why the delta of a put option is less than 0. Something else to keep in mind here is the following. Note that as the stock price, the current stock price, moves away from the strike, then the delta moves towards either 1 or 0 in the case of a call option, or towards -1 or 0 in the case of a put option. Now what's going on here? Well, the easiest way to see why this is happening is the following. We know the value of the call option is given to us by the Black-Scholes formula. However, it is also true, and actually one can check this mathematically with the Black-Scholes formula, that the following is also true. It is equal to, and this is approximately, and I'm ignoring interest rates and so on here, so that's why I'm using the approximate sign here. This is approximately equal to S minus K if S is very large. And by very large, I mean it is bigger than K and much bigger than K. And indeed, it is so much bigger than K that it becomes very unlikely that you wouldn't exercise the option at maturity. Likewise, it is equal to 0 if S is very small. And by very small, I mean S is much smaller than K, and in particular, it is small enough that the chances of exercising the option are approximately 0. And then otherwise, for intermediate values of S, well, we can calculate C0 as being just the Black-Scholes formula. The important thing to note here is that delta C delta S is therefore going to be equal to 1, which is delta S, for S very large, and it's equal to 0 for S very small, and indeed that's what we have here. It's 0 for S very small and a 10 towards 1 for S very large. The exact same argument also holds true for the put price. We know that the put price, of course, is given to us by the Black-Scholes formula for put options, but we can also write this as being approximately, and again ignoring interest rate factors and so on, this is approximately equal to K minus S for S being very small, and it is approximately 0 for S being very large. And for intermediate values of S, we would actually use the Black-Scholes formula. So I'll use BS for Black-Scholes formula in here for intermediate values of S. The important thing to note, though, is that for S very small, then I can use this expression here, and the derivative of this with respect to S is -1. And so that's why I'm getting -1 down here. Similarly, for very large values of S, the put price is 0, or approximately 0. Its partial derivative with respect to S will be 0, and indeed that's what I have up here. So we see that for extreme values of S, the delta of a call option is either 0 or 1, or approximately 0 or 1, and similarly the delta for a put option is approximately -1 or 0. Here we have plotted the delta for 3 different European call options. The 3 options all have the same strike, K equal to 100, but they have different times to maturity. T equals 0.05 years, so approximately 2.5 weeks. T equals 0.25 years, so approximately 3 months. And T equals 0.5 years, corresponding to a 6-month expiration. So we see here the deltas. Notice again, as on the previous slide, for S sufficiently large or small, the deltas go to 0 or 1. But notice that they go to 0 or 1 faster for smaller times to maturity. So in other words, if we look at the case where T equals 0.05, which corresponds to 2.5 weeks, we see that S doesn't have to be too far away from the strike of 100 before its delta goes to 1 or 0. And that's because with only 2.5 weeks to maturity, there's not much chance for the strike to either get into the money if it's down low, or to fall out of the money if it's up high. And therefore the delta quickly goes to 0 or 1 depending on whether or not the current stock price is below the strike or above the strike. And so that's why we see the red curve corresponding to T equals 0.05 years moving to 0 or 1 faster than the options with maturity T equals 0.25 years and T equals 0.5 years. And the same argument, of course, also implies that the T equals 0.25 year option, the delta of this also goes to 0 or 1 faster, if you like, than the option with t equals 0.5 years. Another way of seeing this is looking at the delta not as a function of the stock price, as we did on the previous slide, but as a function of time to maturity. So now we've got time to maturity down here. So 1 corresponds to having 1 year to maturity, 0.5 corresponds to having 6 months to maturity, and 0 corresponds to having 0 time to maturity. We've got 3 different options. We have an at the money option. So an at the money option has K equal to the current value of the stock price. ITM stands for in the money. So a 10% in the money option means that S0 is equal to 1.1 times K. So therefore it is in the money. And a 10% out of the money, OTM option, stands for an option with a strike that satisfies S0 equals 0.9K. And so what we're seeing in this case makes sense. We see that for the option that is out of the money, it is 10% out of the money. So 0.9K, the current stock price, is less than K. So if the option were to expire today, you would get nothing. And therefore what we see is that the delta decreases, and it decreases towards 0 as the time to maturity decreases towards 0. Similarly, the in the money option, where S0 equals 1.1K, so therefore, remember the payoff of the option is equal to the maximum of ST minus K and 0. So if ST is equal to 1.1K, well then this will be equal to 0.1K, so it's in the money. And what we see here is that as the time to maturity goes towards 0, the delta of this in the money option goes towards 1. And that is because as the time to maturity goes towards 0, we become more and more likely to exercise the option. And so the option behaves more and more like ST minus K, because this maximum is going to be equal to ST minus K as the time to maturity goes to 0. And of course the partial derivative of this expression here is equal to 1. And that's why the delta goes to 1. On the other hand, down here in the 10% out of the money case, well then this is going to behave like 0. If we're out of the money, it's going to behave like 0 as the time to maturity goes to 0. And therefore the partial derivative of this will be equal to 0. And that's what we're seeing here. Perhaps the more interesting case is when the option is at the money and K equals S0. Well then in that case, and I'm talking approximately here, the chances of exercising approach 50%. So basically there's a 50% chance of exercising, a 50% chance of not exercising, and it turns out, and it can be confirmed by differentiating the Black-Scholes formula or calculating the expression we saw on the earlier slide, that the delta actually approaches 0.5. The gamma of an option is the partial derivative of the option's delta with respect to the price of the underlying security. So the gamma measures the sensitivity of the option delta to the price of the underlying security. The gamma of a call option is therefore given to us by delta 2C delta S squared. And again, it's somewhat tedious, but it can easily be calculated using basic calculus. We can take the partial derivatives of the Black-Scholes formula to calculate the gamma. If we do that, we will find it's equal to this expression here, e to the minus c times t, n of d1 divided by sigma s square root t. How about the gamma of a European put option? Well, that's easily calculated from put-call parity. So put-call parity is given to us here. So therefore, we can actually say that P is equal to C plus e to the minus RT times K minus e to the minus CT times S. So we can therefore see that delta 2P delta S squared is equal to delta 2C delta S squared. Well, plus 0 minus 0, because the second partial derivative of this is equal to 0, and the second partial derivative of this with respect to S is equal to 0. So therefore we see that the gamma for a put option is equal to the gamma for a call option. So once we know the gamma for a European call option, we therefore have the gamma for a European put option. And in fact, you can see that this expression is always greater than or equal to 0. So the gamma for European options is always positive. This is due to what's called option convexity. Here's the plot of the gamma for European options as time to maturity varies. So the gamma here is a function of the stock price, and we've got 3 different times to maturity: 0.05 years, 0.25 years, and 0.5 years, as we saw before. Notice that the gamma is steepest for the shortest maturity. So in this case, for t equals 0.05 years, i.e. approximately 2.5 weeks to maturity, we see that the gamma is very steep around the strike of k equals 100, but we also see that it falls away to 0 much faster than the option with t equals 0.25 or the option with t equals 0.5 years. The reason is as follows. The delta of the European option with t equals 0.05 years, well, it's going to be a half, or approximately a half, when the stock price is at the strike, k. But as the stock price goes up, the delta is going to move towards 1. And it's going to move towards 1 much faster than the options with the higher time to maturity. Similarly, as the stock price falls below the strike of 100, the delta of the call option is going to move towards 0. And it's going to move towards 0 much faster than the delta of the options with times to maturity of 0.25 and 0.5 years. So this actually is this plot here is just another way of looking at this plot. In the option with t equals 2.5 weeks or 0.05 to maturity, we see that when s equals 100, the delta is approximately 0.5. But for small moves of s above 100, the delta quickly goes towards 1. And for small moves of s below 100, the delta quickly goes towards 0. And it does so much faster than the options with larger times to maturity. So we're seeing that the option, which is 2.5 weeks to maturity, has a much higher gamma than the option with t equals 0.5 years or t equals 0.25 years to maturity. And another way of looking at this is to now plot the gamma as a function of time to maturity. So 1 year to maturity, 6 months to maturity, 0 time to maturity. We see that for the option that's out of the money, 10% out of the money or 20% out of the money, and indeed this would also be true for options that are in the money, the gamma of those options actually goes towards 0. It falls towards 0. And that's because as the time to maturity goes to 0, we know for sure we're not going to be exercising if we're out of the money, and we know for sure that we are going to be exercising if we're in the money. In other words, delta will be 1 if we're in the money, delta will be 0 if we're out of the money, and so gamma will be 0 in both cases. On the other hand, if we're dealing with an at-the-money option where the current stock price is equal to k, so here is where s is equal to k for this blue curve, well then as the time to maturity goes to 0, we're going to find that our delta is equal to a half, but that the gamma will actually be very, very large and grow very large, and that's because small moves in s will move the delta to either 1 if s increases or 0 if s decreases. And so we get a very large gamma for at-the-money options. I should mention as well, by the way, that with all of these plots that we're looking at of delta and gamma, market practitioners understand this behavior. They understand it at an intuitive level. They know how the delta of a call and European put option behaves. They know how the gamma of these options behave. And so it's very important that if you're working with options in practice, you understand these figures and that you understand why they behave and look the way that they do. In the last module, we saw delta and gamma. In this module, we're going to see vega and theta. Vega is the sensitivity of the option price with respect to changes in the parameter sigma, the volatility parameter sigma, whereas theta is the sensitivity of the option price with respect to changes in the time to maturity. So we're going to discuss vega and theta in this module. We'll see how they behave as a function of the underlying security price and indeed as a function of the underlying time to maturity. It is very important that we understand how all the Greeks work, and the vega and the theta are very important Greeks in practice. Again, we have here the Black-Scholes formula. We're going to use the Black-Scholes formula in this module to compute the vega and theta of an option. So just to remind ourselves, the Black-Scholes model assumes that the stock price follows a geometric Brownian motion, so that the stock price at time little t is equal to S0 e to the or minus e minus sigma squared over 2 times t plus sigma wt, where wt is a Brownian motion under the risk-neutral probability distribution Q. So this is the formula here. We saw in the last module what the delta of an option is. We also saw what the gamma of an option is. And we could calculate the delta and gamma by taking the appropriate derivatives of this expression here for a call option. Likewise, we could do the same for a put option, or if we liked, we could use put-call parity to compute those expressions for put options. So first, let's deal with the vega. The vega of an option is the partial derivative of the option price with respect to the volatility parameter sigma. So the volatility parameter is this parameter over here. Now, if you stop and think about it for a moment, you might think that as sigma increases, the value of the option will increase. And indeed, that is true. For example, the payoff of a call option, capital T, CT, is equal to the maximum of 0 and ST minus K. Well, it makes sense. The sigma gets larger, the value of the security will also increase. An easy way to see that perhaps is imagine that S0, the initial stock price, is much less than the strike K. Well, in that case, if sigma is very, very small, the chances of the stock price growing enough so that the option ends up in the money will be 0 or approximately 0. On the other hand, as sigma gets sufficiently large, the probability that ST will be greater than K will actually increase, in which case the option value will be non-zero, and so it makes sense that the call price, the initial price of the option C0, should be increasing in sigma. And we will see that that is indeed the case. The vega of an option is the partial derivative of the option price with respect to the volatility parameter sigma. Vega therefore measures the sensitivity of the option price to sigma. And using the Black-Scholes formula, it can easily be calculated. Vega is equal to delta C delta sigma, which turns out to be e to the minus et s square root of time to maturity times phi of d1, where phi is the probability density function of a standard normal random variable. Now, we can also compute the vega for a European put option by using put-call parity. So this is put-call parity here, remember, so it actually implies, that the put price is equal to the call plus e to the minus RT times K minus e to the minus CT times S. And so therefore we can actually compute delta P delta sigma. We see it's equal to, well, delta C delta sigma. That's the first term here. And then these other two terms don't depend on sigma at all. So it's plus 0 minus 0. And so we see delta P delta sigma equals delta C delta sigma. And so the vega of a European put option is the same as the vega of a European call option. Here's a question for us. Is the concept of vega inconsistent in any way with the Black-Scholes model? And the answer is yes. If you recall, the Black-Scholes model assumes that ST, the stock price at any time t, is equal to S0 e to the mu minus sigma squared over 2 times t plus sigma times Wt, where Wt is a standard Brownian motion. Mu and sigma are constants in this model. They are not assumed to change. And that indeed was the assumption of the Black-Scholes model. They assumed continuous trading, they assumed that there were no transactions costs and that short sales were allowed, and that borrowing or lending at the risk-free interest rate or was also possible. Using these assumptions, they constructed a self-financing trading strategy that replicated the payoff of the option, and that is indeed how they obtained the Black-Scholes formula. Nothing in their model allowed sigma to change. Sigma was a known constant. And yet when we're talking about delta C delta sigma, we're implicitly recognizing the fact that sigma can change. And indeed in the marketplace, sigma does change. So in that sense, While mathematically one can always define delta C, delta sigma, there's no problem with that. Within the economics of the Black-Scholes model, it is inconsistent to talk about sigma changing because we obtained the Black-Scholes option price under the assumption that sigma could not change. Here are some plots of vega for options, for European options, as a function of the stock price at time t equal to 0 and as the time to maturity varies. So we've got three different times to maturity: t equals 0.05 years, t equals 0.25 years, and t equals 0.5 years. There are probably two things to notice first. The first observation is as follows. Note that if I pick any one of these options, the vega goes to 0 as the stock price moves away from the strike, which was $100 here. So what is going on here? Well, it's very simple. So again, returning to what we did in previous modules, we know the following. Let's take a call option as our example. We know that the call option price will be approximately equal to, and again, ignoring interest rate factors and so on, it will approximately be equal to S0 minus K, for S0 being very large. And by very large, I mean much larger than K, and sufficiently large that I'm almost certain I'm going to be exercising the option. It will be equal to 0 for S0 being very small. And very small here means much smaller than K, and indeed small enough that the chances of exercising the option are approximately 0. Well, we can see here that delta C, delta sigma, therefore must be equal to 0 in this situation, because the partial derivative of S0 minus K with respect to sigma is 0, and also 0 down in this situation as well. And therefore for S0 very large, which is up here, or S0 very small, which is down here, we see that delta C, delta sigma goes to 0. And indeed that's what we see for each of these three options. So that's the first observation. The second observation, so let's call this observation 1. The second observation here is that the vega increases in time to maturity, capital T. So we see that the option with t equals 0.5 years, the blue curve here, is larger than the vega for the option with t equals 0.25 years, and so on. And in fact, this is not surprising, because if we go back to the Black-Scholes formula, over here, we can see that every place where sigma appears, we find it together with a square root of t. Or if you like, when sigma squared appears in the Black-Scholes formula, I see a t appearing. So I've got sigma square root t, or sigma squared t appearing here. So basically, every time I see a sigma, I'm multiplying it by the square root of t. And therefore, the impact of a change in sigma, i.e. the vega, it will be amplified by the square root of t. And it is therefore the case, and by the way, maybe I should have mentioned, or it was assumed to be equal to c, was assumed to be equal to 0 in these plots here, we can see that the blue curve is a factor of the square root of t, which is approximately equal to 1.4 times higher than the green curve. And the green curve is a factor of the square root of 5, which is approximately equal to 2.2 something, greater than the red curve. And that's no surprise, because 0.5 years divided by 0.25 years is equal to 2. So the square root of 2 is approximately 1.4, and indeed we see the green curve reaches a peak of 20 here. 1.4 times 20 is 28, and that's roughly the peak of the blue curve. Likewise, down here we have the red curve reaching maybe a peak of approximately 8.5 or 9. 8.5 or 9 multiplied by 2.2 brings us up towards approximately 20. So in fact, this behavior is entirely predictable. The change, the vega for the option is magnified by the square root of the time to maturity. Another way of saying that is, another way of seeing this is by looking at this figure here where we have plotted the vegas for 3 options: an at the money option, a 10% out of the money option, and a 20% out of the money option. And in all 3 cases we see that the vega converges to 0 as the time to maturity goes to 0. And indeed this would also be true if I showed a 10% in the money option or a 20% in the money option. The next Greek I want to talk about is the theta of an option. The theta of an option is the negative of the partial derivative of the option price with respect to time to maturity. So therefore, mathematically speaking, theta equals minus delta C delta T, and that's for a call option. We can also compute it for a put option. If we actually go ahead and do the mathematics, compute the derivatives of the Black-Scholes formula, we will find that theta is equal to this long expression here, where phi is the standard normal PDF. So if you recall, n is the standard normal CDF, and phi is the standard normal PDF. Why do we take the negative? Well, we take the negative because in practice, time goes forward. So in practice, the time to maturity of an option decreases. Suppose I have an option right now which is 200 days to maturity. Well, then tomorrow it will have 199 days to maturity. So therefore the time to maturity is always decreasing in practice, and so it's conventional to take theta to be the negative of the partial derivative of the option price with respect to time to maturity. Here are some figures. Again, we see theta for a European call option as a function of the stock price. K was equal to 100 in these examples. We assumed R, the interest rate, and indeed C, the dividend yield, was equal to 0%. We plot the theta here for 0.05 years, 0.25 years, and 0.5 years. Notice, number one, that the theta is negative in all cases. Now, in general, theta will be negative for European call and put options. It's not always the case that it's negative. There are certain situations where theta could be positive, but in general, most of the time, theta is negative. In other words, when you hold a European call or put option, you lose a little piece of money every day if the underlying stock price does not change. That's what theta means. Remember, theta is equal to minus the partial derivative of the call option price with respect to time to maturity. So as the time to maturity decreases, I lose a little piece of the value of the option. The delta C decreases. Again, another observation is that as the stock price moves away from the current strike of K equal to 100, we see that the theta goes towards 0. And again, we can use our earlier examples to see why this is the case. We know, in this time we'll say in the case, well, we have a call option here, so we'll stick with a call option. In the case of a call option, we know that C0 will be approximately equal to S0 minus K if S0 is much bigger than K or very large, and it's going to be approximately equal to 0 if S0 is much smaller than K. In both cases, the partial derivative of this term with respect to capital T, the time to maturity, is 0. Likewise, the partial derivative of this term, 0, with respect to time to maturity, capital T, is also 0. And so that's why we see for large values of S and for very small values of S, we see that the partial derivative with respect to time to maturity is 0. And that's why all of these curves approach 0 as S moves away from the strike K. Why is the theta most negative around the strike for short times to maturity, that is, for time to maturity of 2.5 weeks or 0.05 years? Well, one way to see that is the following. Suppose I've just got 1 day to maturity. So I've got 1 day, so T is equal to 1 day to maturity. Well then, and suppose the stock price is equal to K, so I'm at the money. This means I've got 1 day to maturity. If the stock price increases, I'm going to exercise the option and make some money. If the stock price decreases over the next day, I'm not going to exercise the money. So the option value will be non-zero at this point because over the next day there is a chance that the stock price will increase and I'll be exercising and making some money. However, imagine rolling time forward 1 day without changing the stock price. Well, in that case, this is going to go to 0 days to maturity. S0 is still equal to K, and now the option expires worthless. So when there's just 1 day to maturity, the theta is larger and more negative, because I have more to lose over the next day than I would if there was 1 year to maturity. If there was 1 year to maturity, I would have 365 days left. Moving time forward 1 day isn't really going to impact the value of the option very much at all. However, when I have just 1 day left to maturity, that 1 day encapsulates all of the value of the option when I'm at the money, and if I roll time forward 1 day without changing the stock price, I'm going to expire worthless and therefore receive nothing. So the theta becomes more negative and peaked around the strike as the time to maturity decreases towards 0. And in this plot, we see the theta for European put options as a function of the time to maturity. We've plotted here 3 different option curves, one for an at-the-money option, the blue curve, and the green and red curves for 10% out of the money and 20% out of the money options, respectively. In fact, just so we're clear, a 10% out of the money option, in this case it's a European put option, so a 10% out of the money option will have K being equal to 0.9 times S0. So the strike is below the current stock price, and so currently it is out of the money. For the 20% case, we will have K equal to 0.8 times S0. So in these cases, we see these out of the money options that their theta is decreasing. Let's take this green curve here. We see theta is decreasing for a while. It's negative and decreasing. But beyond a certain point, there becomes it turns around and moves towards 0, and that's because it's becoming increasingly unlikely that the option will be exercised. Its value is moving towards 0, and so its theta will be 0. The partial derivative of 0 with respect to t is equal to 0. So at this point, the value is moving towards 0 because it's becoming less and less likely to be exercised. The red curve, corresponding to a 20% out of the money option, has actually been turned earlier than the green curve because it's 20% out of the money, it's further away, and so it's becoming less and less likely to be exercised at an earlier point than this green curve here. And in case you're wondering, we can easily create these plots just by using this expression here. This is an expression, so for those of you who are comfortable with coding in R or MATLAB or Python, or indeed in Excel, you could create a table of values for t, create the thetas for these different t values and create a plot. You can easily create these kinds of curves here that I'm showing you. We're now going to discuss the volatility surface. If the Black-Scholes model was correct, the volatility surface would be flat. In practice, it is anything but flat, and we're going to see in this module what the volatility surface is, how it is constructed, and we're also going to see some of the arbitrage constraints that restrict the volatility surface and the shapes it can take on in practice. The Black-Scholes model is a very elegant model, but for several reasons it does not perform very well in practice. The first reason is that security prices often jump. However, this is not possible with geometric Brownian motion. A second reason is that security price returns tend to have fatter tails than those implied by the log normal distribution. By fatter tails, I mean the fact that extreme returns are more likely in practice than you would expect if the security prices actually had log normal distributions as implied by a geometric Brownian motion. Returns also are clearly not IID in practice. So if I'm to break any time period, if I was to break any time period up into finite intervals of time, then if the security price follows a geometric Brownian motion, then log returns would be IID, and this is clearly not the case in practice. By the way, if you want to learn more about geometric Brownian motion, there is a module that we have recorded on geometric Brownian motion that can be found on the course platform. Anyway, for all of these reasons, we know that security prices in practice do not follow geometric Brownian motion, and market participants are well aware of the fact that the Black-Scholes model is a very poor approximation to reality. They've certainly known this since the Wall Street crash of 1987. I will return to discussing the crash of 87 in a while, but It was maybe after this crash that for many people it became clear that the assumptions of geometric Brownian motion did not hold, and that in practice people would have to adjust the Black-Scholes model in an appropriate way in order to trade options. All of that having been said, we have to point out that the Black-Scholes model and the language of Black-Scholes is still pervasive in finance. Most derivatives markets use aspects of Black-Scholes to both quote option prices as well as to perform risk management. So even though the Black-Scholes model is clearly not a good approximation to market dynamics, it is still very necessary to understand the Black-Scholes model if you want to understand derivatives pricing and how derivatives are used in practice. The incorrectness of Black-Scholes is most obviously manifested through the volatility surface. This is a concept that is found also throughout derivatives markets. The volatility surface is constructed using market prices of European call and put options. Now, they can also be constructed using American option prices, but it's a little trickier. So we're going to stick with the case of European call and put option prices. So these include, for example, options on foreign exchange and options on the most commonly traded market indices such as the S&P 500, the Euro stocks, the DAX, the Nikkei, and so on. So all of these indices have options traded on them that are European options, and so everything we say here will apply to those indices and indeed foreign exchange options as well. The volatility surface, sigma kt, is a function of the strike K and the expiration T. It is defined implicitly through this equation here, where C subscript MKT stands for the market price of the call option, and C subscript BS stands for the Black-Scholes price of a call option. Now, in this definition, we're going to use call options, but I can tell you that in the case of European options, we could just as easily use put options. We're going to get the exact same volatility surface. So we will stick with call options here, but again, we could just as easily use put options as well. So what have we got here? On the left-hand side, we have the market price of a call option when the current stock price is S, the strike is K, and the time to maturity is capital T. We can see this in the marketplace. We can go into the marketplace and see how much this call option is worth. That is the left-hand side over here. On the right-hand side, we want to use the Black-Scholes formula for the price of a call option. Now, we're going to know all of these parameters. S, we see that it's the current stock price, time to maturity is known, risk-free interest rate is known, the dividend yield can be estimated, the strike is known, and all we're left with is the implied volatility, sigma kt, or simply sigma as we've been calling it up until now. So what we do is as follows. We equate the market price of the option with the Black-Scholes price of the option, and we solve for the one unknown parameter, sigma. So when we solve this equation for sigma, we are getting what is called the implied volatility for the option. Note also that this implied volatility will generally depend on K and T, and that is why we have written it as sigma of K and T. Here's an example of the implied volatility surface as of the 28th of November 2007 for the Euro Stoxx 50 index. This is an index of stocks traded in the Eurozone. There are 50 securities in the index, and it is the analog, if you like, of the S&P 500 in the US. So there are several points to keep in mind. First of all, we don't see this surface in practice. What we actually see is the following. We see a finite number of options in the marketplace with strikes and maturities K1, T1 up as far as, let's say, KN, TN. So these are the strike maturity pairs for which options are traded in the marketplace. Maybe these values here represent these values of K and T. So I might see a finite number of strike maturity pairs, and I'm plotting them here in the figure. Now, what is done at this point is for each option price, I actually determine the implied volatility. And I do that by working with this equation here. I have my Black-Scholes formula coded up. I can have it coded up in any language I like, in R or Python or Excel. And I see the market price as well. And what I do is I run a simple calibration or root finding algorithm to determine what value of sigma will make this equation correct. And that's how I calculate these values here. So I can get all of these values here, and then I can plot these points here as I have shown. At that point, I now have a finite number of these points. What I do is I fit a surface to this point, and that gives me my implied volatility surface. I need to fit my surface carefully. I'll use some sort of regression or interpolation, extrapolation procedure to complete the surface, and that gives me the implied volatility surface. Now, in practice, to get a surface like this, I would also need to have additional points as well. And I might make some assumptions in order to extrapolate out to the extreme edges, edges both in the strike dimension and in the time to maturity dimension. So that is how I construct my implied volatility surface. And as I mentioned on the previous slide, for European options, it doesn't matter whether I use call or put options, I'm going to get the same surface. Now here's the question. Why will there always be a unique solution sigma kt to this equation here? This is equation 2. How do I know that I will always find a unique solution to this equation here? Well, here's why. The first thing to remember is vega, if you recall vega of a call option was equal to delta C delta sigma, and we mentioned that this is always strictly positive. So now you can imagine drawing the following graph. On the x-axis we will plot sigma, and on the y-axis we will plot the option price C of sigma. Now if this is the 0 value, then maybe the option starts off here, or it'll start off at 0 if it's out of the money, but it'll start off, let's say, at this point here as a function of sigma. And then it's going to grow some way like this. Okay, how do I know it's going to increase? Well, I know it's going to increase because vega equals delta C delta sigma strictly positive. So C is an increasing function of sigma. Now, if I go into the marketplace, I will see the option price in the market, and maybe this will be the option price in the marketplace. So therefore, all I need to do to find my unique value of sigma is to come across here, find out what this value is, and this is my sigma kt. And that is how I know there will be a unique solution to that equation 2. I am assuming, of course, that there is no arbitrage with the market price of the option. Now, if the Black-Scholes model were correct, then we should have a flat volatility surface with sigma kt equals sigma for all kt. After all, remember, the Black-Scholes formula is based on the Black-Scholes model, and the Black-Scholes model assumes that the stock price follows a geometric Brownian motion, so that the price at time t of the stock is given to us by this quantity that I'm writing here, where Wt is a Brownian motion. And here it is assumed that sigma is a constant. So if the Black-Scholes model was correct, and indeed the price dynamics of the underlying security follow geometric Brownian motion, then sigma would be a constant, and I would get sigma kt equals sigma for all k and t. And indeed, it would be constant through time. As I compute the volatility surface on day 1, if I look at it on the next day, I should still see the same constant sigma. So that's what I mean when I say constant through time. In practice, however, volatility surfaces are not flat, and they move about randomly. Indeed, options with lower strikes tend to have higher implied volatilities, and we can see this here. Note that the lower strikes are down in this direction, so we see the lower strikes tend to have higher implied volatilities than higher strikes. For a given maturity t, this feature is typically referred to as the volatility skew or the smile. Notice, for any fixed time to maturity t, suppose I take t equals 2 years, and I look at the slice corresponding to t equals 2 years, I'll still see this behavior where the implied volatilities rise as the strike decreases. So the fact that the volatility surface is not constant is another way to recognize the fact that the Black-Scholes model is incorrect. It is not close to being right, and the market knows it is not correct. For a given strike K, the implied volatility can be either increasing or decreasing with time to maturity. In general, for a fixed K, sigma kt converges to a constant as t goes to infinity. Of course, I should mention, in practice, we will only see options with maturities out to 2 or 3 years. So in general, you actually don't observe sigma kt for t being very large. It is also worth mentioning that when t is small, you often observe an inverted volatility surface, with short-term options having much higher volatilities than longer-term options. And indeed, we see that here to some extent as well. We see that for very small times to maturity and for strikes that are fairly low, or at least moderate to low, we see the implied volatilities are higher than for longer times to maturity. This actually is often true in times of market stress. In times of market stress, there's a lot of worry and concern in the market. People are risk averse. There's a lot of volatility. And as we know, option prices increase with volatility. And so when there is market stress, we tend to see short-term options having higher volatility than longer maturity options. Single stock options are generally American, and in this case call and put options typically give rise to different surfaces. But I mentioned a moment ago, we're not really going to go into this. The general ideas behind a volatility surface can be found by just discussing the case of European options, and indeed that is what we will stick to. Now, the fact that the volatility surface is not constant emphasizes just how wrong Black-Scholes is, and in particular how wrong the geometric Brownian motion model for security dynamics is. That said, pretty much every equity and foreign exchange derivatives trading desk computes the Black-Scholes implied volatility surface for all of the markets they're trading in. So these could be foreign exchange rates like dollar versus euro, or dollar v yen, or euro v pound, and so on. And also for all the main equity indices, the S&P 500, the Euro stocks, the Nikkei, the Dow Jones, the FTSE, and so on. Not only are the volatility surfaces calculated in all of these markets, they also calculate the Greeks. So remember, the Greeks are the sensitivities of the option prices with respect to parameters. So we have the delta, the gamma, the vega, the theta, and so on. We can still calculate all those Greeks using the Black-Scholes formula, but we just have to make sure now that when we use the Black-Scholes formula, we're using the correct volatility, which is a function of the strike and time to maturity. So it is interesting to note how the Black-Scholes formula is wrong, the Black-Scholes model is wrong. Everybody knows it's wrong, and it is wrong for a number of reasons. That said, the Black-Scholes model is still used everywhere. And indeed, use of the Black-Scholes formula is often likened to using the wrong number in the wrong formula to obtain the right price. Where does that come from? Well, if we go back to equation 2, this is what I'm getting at. So the wrong number is this, sigma kt. After all, the Black-Scholes model would assume sigma is a constant. So the wrong number is going into the wrong formula. The wrong formula is the Black-Scholes option price, and it's the wrong formula because we know the Black-Scholes model doesn't hold. So the wrong number goes into the wrong formula to give the right price. The right price is the market price, and of course that is the right price because that's the price of the option in the marketplace. The shape of the implied volatility surface is constrained by the absence of arbitrage, and it is worth making this point here. For example, we know that implied volatilities must be greater than or equal to 0 for all strikes K and expirations T, so therefore we must have this condition here. It is also true that at any given maturity, the skew cannot be too steep. Otherwise, arbitrage opportunities, such as a put spread arbitrage, would exist. Now, what do I mean by put spread arbitrage? Well, I'll answer that here. So let's fix T, and let's look at a slice of the volatility surface. So here I'm going to show you a slice. So T is fixed. Here is K, the strike, and up here I therefore have sigma K. I'm going to exclude T from the argument of sigma because we have it fixed in this picture here. Now, I said that the skew cannot be too steep. Well, what would be too steep? Well, maybe this would be too steep. why can we not get a skew that is too steep? Well, the reason is as follows. Imagine we've got two strikes. So these two strikes, we'll call them K1 and K2. Now imagine we buy a put, maybe I'll write it over here. Imagine we buy a put with strike K2 and we sell a put with strike K1. Well, such a strategy is actually known as a put spread. So if I buy a put with strike K2 and sell a put with strike K1, then this is going to have a positive cost. The value of this will be greater than or equal to 0, and that's because K2 is greater than K1. And so the payoff of the put with strike K2 will always be greater than or equal to the payoff of the put with strike K1. So its value today must be greater than or equal to 0 as well. So therefore, my put spread must have a positive price in the marketplace if there's no arbitrage. However, in my Black-Scholes volatility world, if I have a volatility surface like this, then this is going to be sigma K2, and this will be sigma K1. So clearly sigma K1 is greater than sigma K2. Remember, however, the price of a put option, so the Black-Scholes price of a put option will be increasing in sigma. And if this skew is too steep, then sigma K1 will be much larger than sigma K2, and the put option with strike K1 will be more expensive than the put option with strike K2. And that would introduce an arbitrage, because as I said, in the marketplace, the put with strike K2 must be more valuable than the put with strike K1. But if this gets too steep, then in fact that will be violated and there will be an arbitrage in the volatility surface. So that's what I mean by a put spread arbitrage. Likewise, the term structure of implied volatility cannot be too inverted. What do I mean by that? Well, again, we can draw another picture. But this time we will keep K fixed. So T is actually our variable on the x-axis here. This is sigma of T, and I'm keeping K fixed here. Well, this would be an inverted, what would be called an inverted term structure of implied volatilities. This is just a slice of the volatility surface I showed you a while ago. So for example, if I come back to our picture, I would fix K, so maybe I would fix K at 4,000, and then I would get this slice here. And this would be the term structure of implied volatilities when K equals 4,000. So it would be this guy here. If I'm looking at K equals 3,800, say here, I get this kind of term structure of implied volatilities, and we see that it is inverted at K equals 3,800. So returning to this here, the best way to explain what I mean by counter spread arbitrage is to make the following point. Suppose R equals C, the dividend yield equals 0. Well then, in that case, it can be shown mathematically, if there's no arbitrage, then an option price, let's say a call option price with strike C2 must be greater than the value of a call option price, a call option price with expiration T2 must be greater than a call option price with expiration T1, where T2 is greater than T1. So maybe this point here is T1 and this point here is T2. But if it gets too inverted, the implied volatility for T1 is here, it is sigma T1, and for T2 it is here. And it's the same sort of argument as we used up here for the put spread. If it gets too inverted, then sigma T1 is too large relative to sigma T1, relative to sigma T2, and the call option price with maturity T1 will be greater than the call option price with maturity T2, and that would be an arbitrage. That only holds mathematically when R equals C equals 0, but the same intuition holds more generally. You might want to think, by the way, if you're interested, why in this situation this must hold. Maybe we'll address that in the forums. So to summarize, in practice, the implied volatility surface will not violate any of these restrictions, 1, 2, and 3. Otherwise, there would be an arbitrage in the market. These restrictions can be difficult to enforce, however, when we are stressing the volatility surface. What do we mean by stressing the volatility surface? Well, stressing a volatility surface is something that is often performed in risk management applications. What we do is we have a portfolio of derivatives, maybe a portfolio of options. We know the current value, and we want to see what will be the new value of this portfolio if the volatility surface changes. So what we might do is shift the volatility surface from its current surface to a new surface. That will give us a new value of the portfolio from which we can calculate the profit and loss. So this is something people often do in practice. So it's also an example of a scenario analysis which we saw in an earlier module, where we shift the underlying security by various percentages. We also shift the implied volatilities by various percentages, and we recalculate the value of our portfolio in these scenarios and then compute the profit and loss in these scenarios. So as I said, this is a very important task for risk management. In derivatives portfolios, we need to be able to stress volatilities. We want to be able to stress volatilities in a manner that is consistent with no arbitrage. And so when we are moving an entire surface, we need to do so in such a way that it doesn't violate these no arbitrage conditions. In the last module, we introduced the concept of the volatility surface, and we saw that volatility surfaces in practice tend to have specific shapes. In particular, if you fix a time to maturity and you look at the slice of the volatility surface, then you will typically see that implied volatilities increase as the strike decreases. This is known as the volatility skew or the smile. In this module, we're going to discuss some reasons why we see a skew or smile in practice. So recall, this is our example of an implied volatility surface. This is just the volatility surface for a particular moment in time for a particular underlying security. In this case, it was the Euro Stoxx index in November 2007. We mentioned before that the way this volatility surface is constructed is we have a set of options with strikes and maturities K1, T1 up to say KN, TN. And what we do is we figure out the implied volatility for each of these strike maturity pairs, and we do that, as we said, by equating the market price for the option CMKT, so the market price of the option KITI, with the Black-Scholes price of the option, so at the current price S, or CKITI, and we get sigma KITI. And what we do is we see this in the marketplace. We know all of these parameters, S or C, can be estimated, KI and TI, and so we know the Black-Scholes formula. So the only thing we need to calculate is this, and we explained why we can get a unique solution to this when there's no arbitrage. So what we do is we get the implied volatility at all of these strike maturity pairs that are traded in the marketplace. Maybe that they are these quantities here that I am plotting, and then I actually fit a surface to all of these points. So that's how I get my implied volatility surface. We mentioned as well that one striking feature of implied volatility surfaces in general is the so-called skew. That is, if I fix a particular time to maturity, maybe 2.5, I will see that the implied volatilities tend to increase. Let's say it's here. They tend to increase as the strike decreases. So this is my slice of the volatility surface at t equals 2.5, and I can see that these volatilities are increasing as the strike decreases. So that's called a skew or smile. And after the Wall Street crash of 1987, this skew or smile behavior started to appear in the marketplaces for various derivatives markets, and people started wanting to understand why these skews were there, and they also wanted to be able to build models that produce these skews. So the skew or smile that you see in options markets is a very important feature of those markets. So we're going to discuss a couple of reasons for why a skew actually exists in practice. There are at least two principal explanations for the skew. The first explanation is risk aversion, and this explanation can appear in many guises. For example, security prices often jump, and jumps to the downside tend to be larger and more frequent than jumps to the upside. Another guise is that as markets go down, fear or panic sets in and volatility goes up. A third reason is simply supply and demand. Investors like to protect their portfolio by purchasing out-of-the-money put options, and so there is more demand for options with lower strikes. So if there is more demand for options with lower strikes, then the prices of these options with lower strikes will actually increase, and therefore they will have higher implied volatilities. Note that in making this argument, I'm using the fact that a European option price increases as the sigma parameter increases. So all of these three comments here, or 3 points here, reflect risk aversion in some sense. The fact that when markets go down, people get more worried, markets become more volatile, therefore options become more expensive. Supply and demand, people want to protect their portfolios against the downside or against negative returns in the marketplace. One way to protect your portfolio in that situation is to buy out-of-the-money puts, and so there's a natural demand for out-of-the-money puts in the marketplace. Again, that pushes those option prices up, which is reflected in higher volatilities for these out-of-the-money options. So these points all reflect risk aversion in some form or another. A second explanation is the so-called leverage effect. The leverage effect is based on the fact that the total value of the company assets, i.e. debt plus equity, is a more natural candidate to follow geometric Brownian motion, or at least to have IID returns. So let's spend a little bit of time talking about the leverage effect. Let V, E, and D denote the total value of a company, the company's equity, and the company's debt, respectively. Then the so-called fundamental accounting equation states that V is equal to D plus E. So on the left-hand side, we have V, the value of the firm. This is the value of all of the assets that a company or firm has. Well, if you think about it for a moment, you'll see that all of those assets, all the cash flows produced by those assets, must go to the debt holders and the equity holders. So therefore, we get V equals D plus E. One way to see this visually as well is to break up the total value of the firm into an equity piece, which we will have down here, and up here we've got a debt piece. So this is the total value of the company. We've got it split up into equity and debt. And indeed, equation 3 is the basis for many classical structural models. So we won't be discussing structural models in this course, but I can tell you that these models are sometimes used to price risky or defaultable debt, and indeed credit default swaps as well. Merton in the 70s actually was the first to recognize that equity could be viewed as a call option on V with strike equal to D. And this is valid because debt holders get paid before equity holders. So what Merton was saying is that we can view equity, the equity piece of a firm, or certainly at maturity, if you like, imagine that there's some maturity here, then the equity value at maturity is equal to the maximum of 0 and V minus D. And so what this is doing is, A, it's reflecting the fact that the debt holders get paid off first. So equity is always the riskiest part of the capital structure of a company. So equity holders actually incur losses before debt holders. So if a company is being liquidated at a time capital T, say, then the debt holders must get their money first. And only after debt holders get their money do the equity holders get paid. And what they get paid then is the residual. They get V minus D. But they only get that if D is actually less than V. Otherwise, the limited liability of shares and equity holders means that they will get zero. So Merton was the first to actually make this point. He then actually was able to say, well, let's maybe model the dynamics of V. Instead of saying, let E, the equity piece, or the stock price follow a geometric Brownian motion, maybe we could let V follow a geometric Brownian motion, and then use risk-neutral pricing to actually get the value of the equity, and in turn use that to get the value of the debt as well. So this gave rise to what are called structural models for pricing the components of the capital structure in a company. The capital structure being the equity, the debt, and so on. And by the way, this way of looking at things is very important. It's playing out right now in the global financial crisis as people are talking about banks failing and whether equity holders or deposit holders incur the losses. So all of these ideas we're talking about here are actually very relevant for what's going on in the world right now. To see how the leverage effect can actually give rise to the skew, let's do the following. Let delta V, delta E, and delta D be the change in values of V, E, and D respectively. So this might be over some time horizon T to T plus delta T. Then the fundamental accounting equation again states that this condition, this equation, must be satisfied. And we'll assume that delta T is fairly small, relatively small, so that delta V is also relatively small. So now if we divide across this equation by V, we get the following here. And then all we're doing is rearranging things. We're going to take an E outside here and bring it in down here, and take a D outside this term, and then divide by D over here. So equation 4 is a way of writing the return on the value of the company. So this here is the return on the value of the company. So if I say RV for the return on V, so RV, this is return on the equity piece, and this is the return on the debt piece. So we see that RV is equal to E over V times RE plus D over V times RD. So in other words, we can actually say that the return on the company, the return on the assets of the company, RV, is a weighted combination of the return on the equity part of the company and the return on the debt part of the company. Now, by the way, just as an aside, for those of you that might have studied corporate finance before and capital structure before, we're not going to go into taxes and benefits from taxes on debt and so on. That's another matter entirely. What we're doing here is just trying to understand how the leverage effect can give rise to the skew that we see in implied volatility surfaces in practice. All right, so let's come back to this. So what we will do is we'll assume the following. Suppose that the equity piece is substantial so that it absorbs almost all the losses. So remember, this is how we're thinking of our capital structure. We've got our equity piece down here. We've got our debt piece down here. V is equal to D plus E. Now, if E is substantial enough so that any of these changes in V, losses or gains, can be absorbed by E, then that means that delta D will be very small. If delta D is very small, then we can do the following. Let's take variances across equation 4. If we do that, we'll get the following. We'll get sigma squared V. So this is the variance of the return on the value of the firm, is equal to E over V to be squared times sigma squared E. This is the variance of RE, plus D over V to be squared times sigma squared D, where sigma squared D is the variance of RD, plus twice E over V times D over V the covariance of RE and RD. However, if the equity component is very substantial, so that it absorbs almost all of the losses, and so the debt is not very risky, then delta D will be very small, and in particular sigma squared D and the covariance of RE with RD will be very small in comparison with sigma squared E. So in particular, in this situation, this will be approximately equal to 0. And so therefore I can get sigma V is approximately equal to E over V times sigma E. I can rearrange to get sigma E equals V over E times sigma V. Remember, V equals E plus D, so if I substitute E plus D in for V, I will get sigma E equals 1 plus D over E times sigma V. And so if sigma V is a constant, imagine the value of the assets of a firm following geometric Brownian motion. So if in that case sigma V is a constant, we will see that naturally sigma E will actually increase as E decreases. In other words, even if sigma V is a geometric Brownian motion, then as V goes up or goes down, sigma E will actually change. So sigma V can be constant, but sigma E will therefore be stochastic, and we will see that sigma E will increase as the equity piece decreases. And so this also explains why you would see a skew in the marketplace, why you would see volatilities, implied volatilities, being higher for lower strikes than for higher strikes. This is called the leverage effect. Consider now a 3-month range accrual on the S&P 500 index with range 1500 to 1550. After 3 months, the product pays X% of notional, where X equals the percentage of days over the 3 months that the index is inside the range. So for example, if the notional is $10 million and the index is inside the range 70% of the time, then the payoff will be $7 million. The question is it possible to calculate the price of this range accrual using the volatility surface? The answer is yes. Consider a portfolio consisting of a pair of digitals for each date between now and the expiration. So actually let's expand on this answer and see how indeed we can use the volatility surface to price this range accrual. So let's assume that there are n trading days in the 3-month period in question. Then the payoff at time t, let's write it here, the payoff at time t, let's call it P subscript t, will be equal to 10 million times the summation from I equals 1 to n of the indicator function that the underlying security price, we'll call it SI, is inside the range in question. And this range is 1500 less than or equal to SI less than or equal to 1550. We have to divide by n because it's the percentage of days that were inside the range. And so we must divide. So this summation is the total number of days that were inside the range that the security price, the underlying security price, in this case the S&P 500, is inside the range. So the percentage of days that were inside the range is this summation divided by n. So this is the payoff at time capital T. So how might we price this security? Well, we know, let's write it here, from risk-neutral pricing that the initial value of this security is equal to the expected value under the risk-neutral probability distribution of e to the minus r capital T. Capital T is assumed to be the maturity, so it's 3 months, of times pt. So let's expand on that. This is equal to 10 divided by n. So I'm going to omit the m for million. So now my units are in millions. So it's 10 over n times the summation from I equals 1 to n of e to the minus r times t minus ti times the expected value of e to the minus r ti times this quantity here. Now, what can we do with this? Well, notice, by the way, that I have a minus ti, which is a plus ti, and that cancels with the minus ti inside here. So let's look at this expression here. So we have the expected value of e to the minus rti times the indicator function, that 1500 is less than or equal to Si is less than or equal to 1550, where Si is the underlying security price on day I. Well, I can write this as the following. This is equal to e to the minus rti times the indicator function of Si being greater than or equal to 1500 minus the indicator function of Si being greater than or equal to 1550. So it's quite straightforward to see that this indicator function here, 1 on the event Si is between 1500 and 1550, is equal to the difference of these two indicator functions here. And if you think about it, what you will see is that this is equal to, well, using our earlier notation for the price of a digital option, this is equal to D 1500 on day Ti minus D 1550 on date Ti. And so actually what we've managed to do is we've managed to break down the range accrual into a strip of digital pairs, a different pair for each date Ti. And so therefore the price of the range accrual is equal to $10 million divided by n, the number of days, times the summation from I equals 1 to n of e to the minus r times capital T maturity minus t little I times the digital option with strike 1500 maturity Ti minus the digital option with strike 1550 and maturity Ti. And indeed, we can compute these digital option prices from the implied volatility surface as we saw a short while ago. In this module, we're going to discuss and introduce the Gaussian-Coppola model. This model came in for a lot of criticism during the financial crisis, so it's very much worthwhile introducing it here and seeing how the Gaussian-Coppola model actually works. We're going to use it to construct the probability distribution of the number of losses in a reference portfolio of bonds. This reference portfolio will be the portfolio underlying CDOs and CDO tranches that we will discuss in later modules. We assume there are n bonds or credits in the reference portfolio. Now, I use the word credit here because sometimes that is how the underlying bonds in the pool are referred to. So a credit can refer to a bond, or it can refer to a company like General Motors or Ford or so on. So I'm going to use bonds and credits interchangeably here. Each credit has a notional amount of AI. This is in dollars. However, sometimes it can be expressed as a percentage of the overall portfolio notional. If the ith credit defaults, then the portfolio incurs a loss of AI times 1 minus RI, where RI is the recovery rate, that is, the percentage of the notional amount that is recovered upon default. Now, we've seen this already in the context of credit default swaps. From a modeling perspective, RI is often assumed to be fixed and known. In practice, however, it is random and not known until after a default event has taken place. We're also going to assume that the risk-neutral distribution of the default time of the ith credit is known. And in fact, this can be estimated from either credit default swap spreads or the prices of corporate bonds. Therefore, we can compute QIT, the risk-neutral probability that the ith credit defaults before time t for any t. So we're going to assume that we know these probabilities for all of the names, all of the bonds in the portfolio, and for any time t. Remember, for a credit default swap, you can actually compute the term structure of spreads or premia. So this is T, this is the fair spread in the credit default swap, and you might see some function like this for different maturities. And so you can back off from this what these QI of T's are. So we're going to assume that these QI of T's are known to us. So now let's discuss the Gaussian copula model. We're going to let xi denote the normalized asset value of the ith credit. So xi you can think of, if you like, as referring to di plus ei. So this is the debt plus equity of the ith company. As I said, the company could be Ford or General Motors or Volkswagen or any company you like. We're going to assume that xi is equal to ai times m plus the square root of 1 minus ai squared times zi, where m and the zi's are standard IID normal random variables. Note also that each xi is also a standard normal random variable. Each of the factor loadings ai is assumed to lie in the interval 0, 1. It should also be clear that the correlation of xi xj is equal to ai times aij. And this follows because the correlation of xi with xj is in this case equal to just the expected value of xi times xj. And that is true because the xi's are standard normal random variables, which means they have mean 0 and variance 1. So normally I compute the correlation as being the covariance divided by the square root of the product of the variances. Well, the variances in this case are 1. So now I don't have to divide by anything. The covariance is the expected value of xi xj minus the expected value of xi times the expected value of xj. But the expected value of xi and xj is 0. So therefore the correlation is just equal to this term here, and clearly then this is equal to ai aj times the expected value of m squared, and m is a standard normal random variable, so the expected value of m squared is equal to 1. And so that's how I get this expression here. It should also be clear that the xi's are multivariate normally distributed, and we'll use that as well in a moment. We're going to assume that the ith credit has defaulted by time ti if xi falls below some threshold value xi bar, we'll say. And it's a function of ti, but generally we'll just refer to xi bar. By our earlier assumption, it must therefore be the case that xi bar equals phi inverse of qi of ti, where phi is the standard normal CDF. Why is this? Well, if you recall, we said qi of t is the risk-neutral probability of default by time t. We also said that the ith credit defaults by time ti if xi is less than or equal to xi bar of ti. But the probability of this occurring, we know, is equal to phi of xi bar of ti, because the xi's have a standard normal distribution. So this is equal to phi of xi bar of ti, but we also know it's equal to qi of ti. And so therefore we see that xi bar, just apply phi inverse to both sides of this equation, we'll see that xi bar of ti is equal to phi inverse of qi of ti. We're going to let capital F of T1 up to T capital N denote the joint distribution of the default times of the n credits in the portfolio. Then we know that F of T1 up to Tn must be equal to the following. It's equal to the probability that x1 is less than or equal to x1 bar of T1 all the way up to xn being less than or equal to xn bar of Tn. Because this is the event that x1 up to xn defaults before times t1 up to tn respectively. However, x1 up to xn has a multivariate normal distribution, so this is equal to phi p. The phi is in bold so that it represents a multivariate normal distribution. P refers to the covariance, or in this case the correlation matrix, and it's got a mean 0 as well, and it's evaluated, the arguments of this multivariate normal CDF are x1 bar of t1 up to xn bar of tn. So that gives us this line, and now we just substitute in for these x1 bars using this expression here, and that's how we get this equation down here. So believe it or not, even though this is very simple, there's lots of notation and so on, but it's actually very simple to derive this expression given our assumptions. What we have is the infamous one-factor Gaussian copula model. So this here gives us the one-factor Gaussian copula model. It's a one-factor because we just have one random variable m driving the dependence between the xi's. If we go back to the previous slide, we see m appearing here. M is a random variable that is in common to all of the xi's. So all of the correlation between the xi's comes from this random variable m. If we introduced a second random variable, say n, that was also common to all of the xi's, then we would end up with a two-factor Gaussian copula model. In this module, we're going to look at a simple CDO example where there's just one period in the model. We're going to assume that all the bonds in the reference portfolio have the same risk-neutral probability of default. We'll also assume that all the pairwise default events have the same correlation parameter rho. So these simplifying assumptions will enable us to easily calculate the loss distribution in the bond portfolio, and we will use it to compute the expected tranche loss in some tranches of a CDO. So in this simple example we're going to consider, it is going to be a one-period CDO. CDOs in practice are over multiple periods, but here we're just going to consider a one-period CDO. The maturity is 1 year, or if you like, 1 period. We'll assume that we've got 125 bonds in the reference portfolio. In case you're wondering why are we choosing a number like 125 and not a more standard number like 100, well, that's maybe a legacy of what goes on in the synthetic CDO market, which we will discuss later. In those portfolios you often get 125 bonds in the so-called reference portfolio, and that's why we're using 125 here. We're going to assume each bond pays a coupon of 1 unit after 1 year, and that is if it has not defaulted. The recovery rate on each bond is 0. So in fact, if a bond defaults at any time over the next year, then the bond will pay 0. If it doesn't default, then the bond will pay 1 unit in 1 year's time at the end of the CDO. We will assume that there are 3 tranches of interest: the equity, mezzanine, and senior tranches. So the equity tranche is always the tranche which has a lower attachment point of 0. The senior tranche often has an upper attachment point of 100, but here we're actually going to assume that the senior tranche is exposed to default numbers 7 up as far as 9. And in fact, maybe a super senior tranche would be represented by these dots here, which would contain the defaults or be exposed to the defaults from numbers 10 up to 125. I will mention at this point that this example we're considering is taken from this paper, The Devil is in the Details, Actuarial Mathematics in the Subprime Mortgage Crisis, by Donnelly and Embrix. This is a very nice paper. It discusses CDOs, subprime CDOs, the crisis. It's a little bit technical in part, but much of it is readable for an undergraduate audience, and I'd certainly recommend those of you who are interested in learning more to go ahead and take a look at this paper. It can be easily found online. We're going to make the simple assumption that the probability Q of defaulting within 1 year is identical across all bonds. We're also going to assume that the correlation between each pair of default events is identical. So these assumptions, plus the fact that the maturity is 1 year and that this is just a one-period CDO, is what makes this example particularly easy to analyze. As before, we assume Xi is the normalized asset value of the ith credit, or the ith bond, and now we're going to write that Xi is equal to the square root of rho times m plus the square root of 1 minus rho times Zi. where m, z1 up to zn are IID normal random variables. And recall that this assumption also implies that xi is also standard normal mean 0 variance 1. Recall that the ith credit defaults if xi is less than or equal to little xi bar. Therefore, the probability that the ith name defaults is equal to the probability, we'll write it up here, that xi is less than or equal to little xi bar. This must be equal to phi of little xi bar, because xi is a standard normal random variable and phi is the standard normal CDF, so this is true. But we're also assuming that this is equal to q. This is the probability of defaulting within 1 year, so this is equal to q. And from that, we see that if I take phi inverse across both sides of this expression here, I see xi bar equals phi inverse q. And that's what we have down here. So the probability that xi defaults, conditional on m, is going to be equal to the probability that xi is less than or equal to little xi bar. I can substitute equation 3 in down here. Replace xi bar with phi inverse q, take the m term over to the right hand side, divide it by the square root of 1 minus rho, and I get this expression here. This is what we're going to call q subscript m. This is going to be the risk neutral probability that xi defaults, conditional on knowing the value of the random variable m. What is also clear is that this is equal to the standard normal CDF evaluated at this value here, because Zi is a standard normal random variable. Therefore, conditional on knowing the value m, the total number of defaults is actually binomially distributed, with parameters n, the number of names in the portfolio, number of credits, and number of bonds, and probability qm. Why is that? Well, if you think about it, conditional on knowing m, we've already seen what the probability of default is. It's qm. But also, conditional on knowing m, all of these default events become independent, because xi depends on m and zi, and the zi's are IID normal random variables. So if I condition on the value of m, then the xi's become independent, which in particular means that the default events of all of the names in the portfolio are also independent. The probability of default conditional on m is qm, so therefore the total number of defaults in the portfolio conditional on m has a binomial distribution with parameters n and qm. So therefore, the probability of L defaults, and note I've dropped the dependence on t here, which is fine because we're just considering one period with t equals 1 year. So therefore, the probability of L defaults out of the n names in the portfolio, or n credits in the portfolio, conditional on the value of m, is binomially distributed. And this is equal to n choose L times qm to the power of L times 1 minus qm to the power of n minus L. Where phi, as we said in the previous slide, is the standard normal CDF, and we know this expression for qm as well. Recall that q is the risk-neutral probability of a single name defaulting within 1 year. So just to be clear, you shouldn't get confused between q and qm. Q is the risk-neutral probability of a single name defaulting within 1 year, and qm is the same probability, that is, the risk-neutral probability of a single name defaulting within 1 year, conditional on the value of m. So here are two questions. The first question is the following. When correlations and default probabilities are not identical, why is 4 no longer valid? Well, that's because if the correlations and default probabilities are not identical, then these QMs are not the same for all of the names in the portfolio. You end up having a different QM for each of the n names. So this quantity here is no longer a binomial random variable or a binomial probability. Next question, how do we calculate P superscript n Lm in that case? Well, we just do it as we did in the last module. We saw we had an iterative algorithm. Remember, we had the 2 nested for loops. That was the way how we calculate Pn of L in general. In this example, we don't need to run through those 2 for loops because here we can just use the fact that the QMs are identical for all names I equals 1 to capital N, and therefore this is a binomial probability, and we know this expression. So at this point in this example, we actually know this quantity here. This quantity is a binomial probability, assuming we can calculate QM, and we can, because QM can be calculated as this expression here. We know these binomial probabilities, and so in particular we know the risk-neutral probability of L defaults occurring conditional on the random variable M. How can we use this knowledge? Well, we can use it to compute the expected tranche losses. And that's what we're going to do in this slide. First of all, maybe I should go down to equation 5 first. So remember, what we're going to say is the following. The probability of L losses is equal to the probability of L losses given M times phi M, and integrate that with respect to M. That's just using this trick we mentioned before from our undergraduate probability course. If I want to know the probability that x is equal to little x, well, I can do that by summing over y, the probability that x equals little x, y equals little y, which in turn is equal to the sum over little y of the probability that x equals little x given y equals little y by the probability that y equals little y. So here we're identifying M with the random variable y, and instead of a summation we have an integral. But that's all we're doing here. So we know how to compute these quantities. We saw that on the previous slide. These are binomial probabilities. So these are binomial probabilities, and therefore we can do a numerical integration to calculate P of L for any value of L equals 0 up to capital M. So we know the P of L's. We can do it very easily by integrating this expression numerically. So now let's turn to the issue of computing the expected tranche losses. In the equity tranche, we can actually lose either 0, 1, 2, or 3. So the expected equity tranche loss will be K equals 1 times the probability of 1 default by year end, plus K equals 2 by the probability of 2 defaults by year end, plus K equals 3 by the probability of 3 or more defaults by year end. Remember, the equity tranche is on the hook, if you like, for the first 3 losses in the portfolio. So the most that the equity tranche can lose is actually 3. But it will lose 3 if we have 3 or more defaults by year end. And so that's how we get the expected equity tranche loss. Let's turn, for example, to the expected senior tranche loss. Well, the senior tranche can only lose 1, 2, or 3. We see back here that the senior tranche is on the hook for defaults 7 to 9. So the most it can lose is 9 minus actually 6, which is 7 minus 1 is 3. So it's on the hook for these 3 defaults, 7, 8, and 9. So it's on the hook for 3 units. The most it can lose is 3 units. It will lose nothing if there are less than or equal to 6 losses in the portfolio. It will lose 1 if there are exactly 7 losses in the portfolio. It will lose 2 if there are exactly 8 losses in the portfolio. And it will lose 3 if there are 9 or more losses in the portfolio. And that's represented over here in this expression for the expected senior tranche loss. So you should make sure that you're very comfortable and understand where these expressions come from. The equity tranche is on the hook for the first 3 losses. The mezzanine tranche is on the hook for the next 3 losses. So those losses will be losses 4, 5, and 6. The senior tranche is then on the hook for the next 3 losses, which would be losses 7, 8, and 9. And so these are the expected tranche losses for each of those 3 tranches. In this module, we're going to continue on with the example we introduced in the last example. That was a simple model. It was a one-period model with identical risk-neutral default probabilities for each bond in the reference portfolio, and so on. So what we're going to do here is we're going to look at some of the tranche losses, or the expected tranche losses, and we're going to look at the characteristics of these expected tranche losses as a function of the correlation parameter rho, and so on. we're also going to see how the total expected losses in a portfolio does not depend on the correlation parameter rho. So recall the details for our simple example. We want to find the expected losses in a CDO or in CDO tranches with the following characteristics. The maturity is 1 year and it's just a 1-period CDO. There are 125 bonds in the reference portfolio. Each bond pays a coupon of 1 unit after 1 year if it has not defaulted, and the recovery rate in each bond is 0. So in particular, if a bond has defaulted before the 1 year is up, then that bond will pay a coupon of 0. There are 3 tranches of interest: the equity, mezzanine, and senior tranches. The equity tranche is exposed to defaults 0 to 3. The mezzanine tranche is exposed to defaults 4 to 6. And the senior tranche is exposed to defaults 7 to 9. We saw in the last module that we could actually compute the expected tranche losses. We saw our expressions for the expected loss in the equity tranche, the expected loss in the mezzanine tranche, and the expected loss in the senior tranche. So on this slide, we're actually going to see what these expected losses are as a function of rho, which is the common pairwise correlation between the various names in the portfolio, and the individual risk-neutral default probabilities. So this is the Q equals 1%. So this corresponds to the case where the probability of each individual name defaulting is 1%. So there's 125 bonds in the portfolio. We assume each of them defaults with probability Q equals 1% here. Over here, each of them defaults with probability Q equals 2%, down here 4%, and over here 3%. And on the y-axis, we have the expected losses. Note, we have 125 names in the portfolio. Each name will pay 1 unit if it hasn't defaulted after 1 year. So therefore, the total portfolio notional is 125. The equity tranche is on the hook for the first 3 losses, so the equity tranche can lose a maximum of 3. The mezzanine tranche is on the hook for losses 4, 5, and 6, so the maximum the mezzanine tranche can lose is also 3. Likewise, the maximum the senior tranche can lose is also 3. It's on the hook for losses 7, 8, and 9. So the maximum loss in any of these tranches is 3, and that's why you don't see in any of these cases anything greater than 3 on the y-axis. Across the x-axis, we're actually plotting these expected losses as a function of the correlation parameter rho. So this is that value rho we saw in the last module, which defines the normalized asset value xi. So there are some important observations we should make here. The first observation is the following. Regardless of the individual default probability Q and correlation parameter rho, we see that the expected equity tranche loss is greater than or equal to the expected mezzanine tranche loss is greater than or equal to the expected senior tranche loss. Now this only holds when each tranche has the same notional exposure, in this case 3 units. So we see it here. We see the blue line, which is the expected tranche losses in the equity tranche, is always greater than or equal to the red line, which corresponds to the mezzanine tranche, which in turn is always greater than or equal to the senior tranche expected losses. And that makes sense. After all, we can see that the equity tranche is the riskiest. You can only lose, the mezzanine tranche can only lose if the equity tranche has already lost everything. In other words, if you have 4 defaults so that the mezzanine tranche loses 1 unit, then that means we've had more than 3 losses and the equity tranche has lost everything. Similarly, if the senior tranche is to lose anything, then that can only be the case if we have 7 or more losses, which means the equity and mezzanine tranche have already lost everything as well. And so we should be absolutely certain and understand why the expected losses in the equity tranche must be greater than or equal to the expected losses in the mezzanine tranche, must be greater than or equal to the expected losses in the senior tranche. Another important observation is that the expected losses in the equity tranche are always decreasing in this correlation parameter rho. So we see it here. So let's pick Q equals 2%, for example. If we look at Q equals 2%, we can see that the equity tranche losses is a decreasing function of rho. And in fact, it's true in all 4 graphs. It's always a decreasing function of rho. why might this be the case? Well, one easy way to see this perhaps is the following. Imagine two possibly different values of rho. So imagine rho being equal to 0 or rho being equal to 1. Well, if rho is equal to 1, well then what happens? Either all of the names, all of the credits default together, or none of them default together. So in that case, the equity tranche will actually be as risky as the senior tranche, because either all of the names default or none of them default. The probability of all of them defaulting will therefore just be Q equals 1% in the 1% case, or 2 in the 2% case, and so on. So in other words, let's consider this example here. So the Q equals 1% case. For numerical reasons, we didn't take a value of rho all the way equal to 1, but we can look at the value rho equals 0.99 to see what's going on. In this case, either all of the names default together or none of them default. In that case, the three tranches are all equally risky, and so the probability of any one defaulting is 1%, so the expected losses in the tranche is going to be 1% times 3, which is 0.03. So this value here is roughly 0.03. On the other hand, if rho equals 0, well, because there's no correlation among default events, we would always expect there to be maybe just one default or one or two defaults or 0 defaults. But what it means is that most of the time we're actually going to see a default. Maybe 1, maybe 0, but sometimes 2 or 3. And so with such a low correlation, we'll always expect to see some credit event happening. And because it's the equity tranche that is on the hook for that first credit event, we expect the equity tranche to incur losses most of the time. And that's why we see this number being much higher for a low value of rho. And in fact, we'll see this behavior for all values of Q. Down here, for example, we see Q equals 4%, and we see the expected tranche losses is now almost 3. And that's because we expect, with Q equals 4%, we expect there to be 4% of 125, which is 5. So we expect to see, on average, 5 losses in the portfolio. Because correlation is very low down here, we're always going to expect to see almost 5 losses in the portfolio, which means that most of the time the equity tranche will be wiped out. We're going to see more than 3 losses. Most of the time we're going to see 4 or 5 losses maybe. So that's why it will be wiped out. Down here, for example, when rho equals 0.99, sure, we do on average expect to see 4% losses, which corresponds to 5 names defaulting, but they're all going to default together or not at all, which means 96% of the time, in fact, the equity tranche won't be hit at all, and only 4% of the time will it see a loss of 3. 4% of 3 is 0.12, so this number here is roughly at the 0.12 level. So that's the first two observations. Another observation to note is the following. Mezzanine tranches are often relatively insensitive to rho. We can see that, for example, perhaps most easily in this plot when Q equals 1%, which in many cases in practice might be the most relevant example, because in practice, depending of course on the nature of the names in the portfolio, you will often see a Q of approximately 1%. So you see here that actually certainly maybe in this range here that I'm circling, you see that the expected tranche losses don't vary much with rho at all. And actually this is a commonly observed phenomenon. Also, it actually has implications when it comes to model calibration. Now, we're not going to get into model calibration for this Gaussian Coppola model. I might say a few words about it in a later module, but generally we won't have time to go into it in any detail. So that's the third observation here. So I have 2 more observations I want to make, but I'm going to make those observations when we change the problem slightly. In the remainder of this module, we're going to assume that the senior tranche is now on the hook for all losses between 7 and 125. So it's not between 7 and 9, it's all losses between 7 and 125. What we will see then, and we'll see it on the next slide, is that the expected loss in this senior tranche, sometimes called a super senior tranche, we'll see that it's increasing in rho. And sure enough, we can see that. So this is the green here. We see it is always increasing in row regardless of the value of Q. And actually the reason for this is the same reason why the equity tranche expected losses are always decreasing in row. So the same intuition I gave will actually also apply in the opposite direction to the expected losses in the senior tranche. The final thing to note, and this mightn't be so obvious from the figure because I'm not giving you the individual numbers, but the total expected losses on the three tranches, that is, the expected losses on the index. Remember, all of the index now, the index consists of all 125 names, and the three tranches are equity 0 to 3, the mezzanine tranche 3 to 6, and now the senior or super senior tranche is 7 to 125. So now these three tranches now all add up to the entire index, all 125 names. And the point I'm making, and you can see it on the next slide, is that the total expected losses on the three tranches is independent of row. This is not an accident. So what am I getting at here? Here's what I'm getting at. Let's pick this figure here, Q equals 3. If I fix a value of row, say row equals 0.1, and sum up the losses for the three tranches at row equals 0.1, I'll be summing up maybe this number, plus this number, plus this number. And that will equal to the losses at any other value of row. So if I take row equals 0.7, then this, and this number here, the sum of these three will be equal to the sum of these three numbers over here. Why is this occurring? Well, we can analyze it. We can show that this is no accident as follows. The expected losses using the risk neutral probabilities, so the expected total loss is equal to the expected value of the sum of the losses from I equals 1 to 125 of the indicator function that the ith bond or name defaults. I'll just use the capital letter D and EEF to denote default. Now I would normally multiply this by AI times 1 minus R I, but by assumption we've said that the AIs are equal to 1 and the RIs are 0. So in fact this term here is just 1. So in fact I can ignore this piece here and I get that. Well, this is just equal to the sum from I equals 1 to 125 of the expected value of the indicator function of the ith name defaulting and this is equal to the sum from I equals 1 to 125 of the probability of the ith bond defaulting. And the important thing to notice here is that this, the probability of the ith bond defaulting, well, this is equal to our Q, but this certainly does not depend on rho. And so we see that the expected total loss in the portfolio, which is equal to the total loss in the sum of the three tranches in this case, is equal to this quantity over here, and that does not depend on rho. And that's why we see this behavior I was describing a moment ago. However, it is worth pointing out that the allocation of these losses to the three tranches, the three separate tranches, does indeed depend on rho. We can see, as before, that the expected tranche losses in the equity piece are decreasing in rho. This will always be the case for an equity tranche with lower attachment point equal to 0. Similarly, we can see that the expected tranche losses in the senior tranche are always increasing in rho. And this is true for any senior tranche with an upper attachment point of 100%, or in this case, 125 units. In the last module, we saw the mechanics of a synthetic CDO tranche. We saw there was a premium leg and a default leg. Well, in this module, we're going to price the premium leg and we're going to price the default leg. We're then going to set these two prices equal to each other, and as a result, we will be able to calculate the fair premium of a CDO tranche. So let's start with calculating the fair value of the premium leg. The premium leg represents the premium payments that are paid periodically by the protection buyer to the protection seller. These payments are made at the end of each time interval, and they are based upon the remaining notional in the tranche. In this sense, it is different to a CDS, since the latter contract ends as soon as the default occurs. Here in the CDO, a CDO can survive well beyond an initial default. Multiple names can default, and the CDO tranche, may need to pay out upon each default event. Formally, the time t equals 0 value of the premium leg, which we're going to call P subscript 0, 0 denoting t equals 0, and superscript LU, which refers to the lower and upper attachment points respectively. So this quantity is equal to what's on the right hand side here of expression 6. So we have S, which is the annualized spread or premium paid to the protection seller. So this will be a percentage. It might be 2%, it might be 3%, or it might be 10% for a tranche where you expect to see many losses, but maybe it'll just be 0.25% or some very small number as well for a tranche which is relatively safe. DT is the risk-free discount factor for payment date T. Delta T is the accrual factor for date T. So typically delta T would be approximately 1/4, corresponding to quarterly payments. N is the total number of periods in the contract. So for example, if the CDO lasts or has a maturity of 10 years and payments are made quarterly, then this implies N will be equal to 40. So what's going on here is that the fair value of the premium leg, this is the fair value of the premium payments made over the N payments. It's equal to S times delta T, the sum from T equals 1 to N of S times delta T. Remember, S is an annual spread or premium, so we've got to multiply it by delta T to get the payment made per period. So it's S times delta T times the expected notional remaining between periods T minus 1 and T. So remember, the total notional of the tranche is U minus L. So if U is 7% and L is 3%, then the total notional of the tranche is 7 minus 3 equals 4%. The total losses in the tranche can't exceed U minus L. So this expression here is equal to the expected notional remaining at time period T minus 1. And so the insurance, the S times delta T, is made on this expected notional. Those payments which occur at time T then must be discounted back to time 0, and that's why we have this risk-free discount factor here. Now I should mention, I'm not going to worry about accrued payments and so on. In practice, default events don't take place at the beginning or end of a 3-month period. They might take place in the middle, and maybe you'll have some accrued payments as well, but we're not going to get into that. The other leg of the CDO tranche is the default leg. The default leg represents the cash flows paid to the protection buyer upon losses occurring in the tranche. Formally, the time T equals 0 value of the default leg, which we're going to call DL, subscript 0 for T equals 0, superscript LU, satisfies this equation here. Again, DT is the discount factor. We have a sum from T equals 1 to N, representing the N periods in the CDO. And so payments occur when there's a default in the tranche. And the expected payments at time T is given to us by this. Because if you think about it, this is the expected tranche loss at time T minus 1. This is the expected tranche loss at time t. So the difference is the expected tranche losses in the period from t minus 1 out to t. So these are the expected payments that must be paid by the seller of protection or the seller of insurance between times t minus 1 and t. So these are the risk neutral expected losses in the tranche between these two periods, and we have to discount them back to time 0 using the discount factor dt. So while some programming is required, we can actually calculate these quantities very quickly. If I go back to the previous slide, I will see that I also have an expectation of a tranche loss appearing here as well. So the key to computing the premium leg value and the default leg value is being able to compute these expectations here. Now, if you recall, just to remind ourselves, we know that the tranche loss function is given to us as follows. We know that TL subscript T superscript LU, it's a function of the number of defaults in the underlying pool of bonds or pool of credits. We know that that is equal to the maximum of the minimum LA 1 minus R, comma U, minus L and 0. Now the only random variable in here is L, the number of losses in the portfolio. We also know that the expected value of the tranche loss at time t is equal to the sum from L equals 0 up to capital N TLLU T of L times PL of T. PL of T we saw in the one-factor Gaussian model. This is equal to the integral from minus infinity to infinity of P superscript N LT given M times the probability density function for standard normal random variable phi m dm. And finally we saw that in general we could compute this using our iterative algorithm. That was the algorithm with the nested for loops, if you recall. We had a for, I think it was for I equals 1 up as far as n, and then we had for j equals 1 to I, and so on. So if you think about it, the big picture here is as follows. We want to be able to compute the fair value of a CDO tranche. In order to compute the fair value of a CDO tranche, we need to be able to compute the fair value of the premium leg, the fair value of the default leg, and what we're going to do is we're going to set those two fair values equal to each other to get the fair value of the spread S. But before we do that, we need to be able to compute the expected tranche loss function. And we can see, as we've written here, that this expected tranche loss function ultimately comes down to computing this integral here, and we can do this numerically. So while we do need some programming, we do need to write some code to actually compute this quantity, we can actually get it to run very quickly. And in fact, this is the principal reason for the Gaussian copula model's popularity. It has many flaws. We may discuss a couple of them in a later module if we have time, but the reason it is so popular is because it enables us to price very quickly a security that is in fact very complex. Remember, in a CDO tranche we might have 100 names or 125 names in the underlying portfolio. Each of these names have different risk-neutral probabilities of default at various times. They all have different pairwise correlations and so on. So it's a very complicated product, a very complicated security with many moving parts. And this Gaussian copula model enables us to price the premium leg and default leg of a CDO tranche very efficiently in practice. Okay, let's move on to the final slide here. How do we compute the fair value of a CDO tranche? Well, just like a regular swap, what we do is we determine the fair premium, S star say, so that the premium leg is equal in value to the default leg. And so all we do is we equate 6, which is this is the fair value of the premium leg. We're going to equate this leg with the fair value of the default leg, which is given to us by 7, and we're going to solve for S, and we're going to call that solution S star. And so we get S star equals to this expression here. Now, one thing to keep in mind with this expression here is model independent. We did not need a model to compute S star. S star follows just by equating the premium leg with the default leg, and the quantities we need to actually compute S star are these expectations here. I mentioned in the previous slide that we can compute these expectations numerically very easily using the Gaussian-Coppola model. So this is where a model comes in. So we need our model for this piece. Okay, and it's the Gaussian-Coppola model which became the standard in industry for computing these quantities. So as is the case with swaps and forwards, the fair value of the tranche to the protection buyer and seller at initiation, at the beginning of the contract, is therefore 0. It is easy to incorporate any possible upfront payments that the protection buyer must pay at time t equals 0, in addition to the regular premium payments. So that's also easy to handle, but we won't get into it. Actually, it's also possible to incorporate recovery values and notional values that vary with each credit in the portfolio. Here we've assumed that Ri is equal to a constant R for all I, and we've also assumed that the notional value Ai is equal to A for all I. But again, I just want to emphasize that we could still use the Gaussian-Coppola model even if these assumptions didn't hold. In practice, the way it works is similar to what we saw when we were looking at the implied volatility surface for equity options. In practice, we actually don't compute S star. We actually see S star in the marketplace. There would be a market for these tranches in the marketplace. We would see the fair spread, S star, in the marketplace. And what we would try and do is back out a correlation parameter, let's call it rho say, which meant that this right-hand side, or that the model fair price S star of rho was equal to the S star we saw in the marketplace. And then rho would be called an implied correlation parameter. So very analogous to what we saw with equity options and computing implied volatilities for a given strike and maturity. One point that's worth emphasizing is that if this Gaussian-Coppola model was somehow correct, then you should see the same correlation value for different tranches. In other words, suppose I compute the fair correlation for a tranche with attachment points, say 3% and 7%, and then I can back out a correlation parameter rho. Well, I should see the same rho if I change 3 to be 7 and I make 7 equal to 10, say. In other words, if the model was correct, I should see the same value of rho regardless of what values of L and U I use. But in practice, this is not the case. We see a different implied correlation for different attachment points L and U. And in fact, it's possible in some circumstances to not be able to back out an implied correlation parameter at all. Up until now, we focused mainly on synthetic CDOs. Well, we haven't actually described yet what a synthetic CDO is, and we haven't compared it to what a cash CDO is. In this short module, we're going to discuss first cash CDOs, and then we will discuss synthetic CDOs and describe the differences between these two types of CDO. The first CDOs to be traded were all cash CDOs, where the reference portfolio actually existed and consisted of corporate bonds that the CDO issuer usually kept on its balance sheet. Capital requirements then meant that these bonds required a substantial amount of capital to be set aside to cover any potential losses. Now, sometimes the banks, however, often wanted to reduce these capital requirements. They didn't want to tie up capital with these bond portfolios. So what they did instead was they converted the portfolio into a series of CDO tranches, and they sold most of these tranches to investors. they usually kept the equity tranche for themselves, and therefore they actually kept most of the economic risk and rewards of the portfolio. If you recall, the equity tranche is the riskiest tranche. It has a lower attachment point of 0, and it could have been 0 to 2% or 0 to 5% or some such number. And so most of the time at many of these tranches or CDOs, all of the losses would have occurred just in this equity tranche. So effectively the equity tranche incurred all of the economic risk and reward of the portfolio. However, by selling off these other tranches, the banks were able to reduce substantially the amount of capital they needed to set aside. And so they're able to keep on the economic risk and reward, which is what they wanted to do, but they did not need to set aside an enormous amount of capital. And so these first CDO deals were therefore motivated by what is called regulatory arbitrage considerations. The idea is that they were arbitraging the regulations, which said they would need to hold a substantial amount of capital for this economic risk. But in fact, what they did was they just tranched the portfolio up, kept the riskiest tranche here, which meant they kept pretty much all of the economic risk in the portfolio, and they were able to substantially decrease the capital requirements for just holding this piece of the portfolio. So that's what regulatory arbitrage refers to. The cash CDOs, however, must be managed, and the legal documentation can be lengthy. You've got what are called waterfall structures to manage and design. You've got what's called credit enhancement and so on, and other important features. So what, for example, is a waterfall structure? Well, a waterfall structure describes what happens to coupons, prepayments, for example, in the event of a loan pool or a mortgage loan pool underlying the CDO. You might have some derivative securities inside the CDO in order to change some of the characteristics of the underlying cash flows. Maybe you've got some floating rate bonds in the underlying pool of bonds and you want to convert them into fixed rate bonds. Well, you could use an interest rate swap to do that. So you will often have extra factors inside a cash CDO that need to be managed. Credit enhancement, on the other hand, refers to a feature of many CDOs. The issuer of the CDOs may want the tranches to receive better credit ratings. And credit enhancement refers to methods for doing this. One common way of doing credit enhancement is to over-collateralize the CDO. What that means is if the nominal notional of the CDO, let's say it's $100 million is the nominal notional of the CDO, well, the bank might actually put $101 million into it. So there's an extra $1 million, and that extra $1 million would be referred to as an over-collateralization amount. So there's different ways to make the tranches seem a bit safer and therefore to get higher ratings from the ratings agencies. We don't have time here to go into how these ratings agencies actually rated these CDOs, but I think it's fair to say that they didn't do a very good job of this. These structures are very, very complicated. The waterfall structures make them even more complicated, and the idea that you could actually create models to actually understand the riskiness of these securities is somewhat optimistic, to say the least. But as I said, we won't go into this issue any further. Once these cash CDOs came into the marketplace, it became clear that there was an appetite in the marketplace for these products. Hedge funds, for example, were often very keen to buy the riskier tranches, the equity tranches, and that's because the equity tranches, having the most risk, also had the greatest expected reward or expected payoff in the future. So hedge funds were often keen to buy the riskier tranches. Insurance companies and so on often sought to purchase the AAA rated senior and super senior tranches. Remember, these senior and super senior tranches are the safest tranches, so you rarely expect to see any losses entering into these tranches, and so they're considered very safe. They were typically AAA rated products, but maybe by selling insurance on these senior tranches, the insurance sellers might get 10 or 15 basis points more than they would get from buying AAA rated products out in the marketplace. Maybe by buying AAA corporate bonds, maybe the coupons on those AAA corporate bonds were just a little bit less than the premium they could earn by selling protection on AAA rated senior and super senior tranches. This appetite and explosion in the CDS market gave rise to so-called synthetic tranches, where the underlying reference portfolio is no longer a physical portfolio of corporate bonds or loans. Instead, it was a fictitious portfolio consisting of a number of credits with an associated notional amount for each credit. If you are confused by the distinction between cash and synthetic CDOs, imagine a series of football games, for example. So let's suppose Barcelona are playing, I don't know, let's say Bayern Munich, Arsenal are playing AC Milan, Real Madrid are playing Manchester United, and let's say Juventus are playing Paris Saint-Germain. So we've got 4 games here. Now what we can do is we can actually bet or speculate, or if you like, invest or hedge on the outcomes of these 4 games. And we can do that without anyone actually owning these games. In fact, I'm not even sure what it means to own a game, but it certainly doesn't stop us from constructing a bet or a payoff or a security whose cash flows depends on the outcomes of these 4 games. So now you can imagine doing the exact same, but instead of having these 4 football games, we replace them with 4 credits, maybe General Motors, maybe Ford, maybe IBM, maybe Siemens. And now we can construct securities whose payoff depends on what happens to these securities. So that's how a synthetic CDO works. We don't own the underlying bonds. There isn't a reference portfolio of bonds on GM, Ford, IBM, Siemens, and so on that the bank owns. We just refer to these credits. Just like we don't own these football games, we can still bet on the outcome of these games. Likewise, we can invest in tranches whose payoffs depend on what happens to General Motors, Ford, IBM, and Siemens, and in particular on whether these companies default or not over a specified period of time. And so that's what I mean by a fictitious portfolio. There doesn't have to be an underlying physical portfolio of bonds, of GM bonds, Ford bonds, IBM bonds, and Siemens bonds. We can just see these names out in the marketplace. We can see at any point whether they've defaulted or not, and we can construct securities whose payoffs depend on the default events of these underlying names or this underlying fictitious portfolio. The mechanics of a synthetic tranche are precisely as we described earlier. When we introduced the Gaussian-Coppola model and we looked at that 1-period example, we were actually pricing synthetic tranches. We were computing the expected tranche loss on such a synthetic CDO. There are at least 2 features that distinguish synthetic CDOs from cash CDOs. Number 1, with a synthetic CDO, it is no longer necessary to tranche the entire portfolio and sell the entire deal. For example, a bank could sell protection or sell insurance on a 3% to 7% tranche and never have to worry about selling the other pieces of the reference portfolio. This is not the case with a cash CDO. In the case of a cash CDO, the bank would own all of the underlying bonds. If it sold the 3 to 7% tranche, let's say this one, it would still then be on the hook for the equity tranche and these tranches up above the 3 to 7% tranche. This is not the case with the synthetic CDO because the underlying portfolio doesn't exist in the first place. The bank is just selling protection on a 3 to 7% tranche, and as I said, it doesn't have to worry about selling the other pieces of the reference portfolio. But because of this, we come to issue 2. Because the bank no longer owns the underlying bond portfolio, it is no longer hedged against adverse price movements. It therefore needs to dynamically hedge its synthetic tranche position. Typically, it might do this, or would have done this in the past, using the CDS markets, but hedging and risk managing CDO portfolios is very difficult in practice, and this is true regardless of whether or not you have a good pricing model. There are simply too many moving parts. There are too many names in the portfolio. There are too many different individual default probabilities. You've got different industries and different correlations between securities and different industries and so on. These are very complicated securities and very difficult to hedge dynamically and risk manage. In this module, we're going to discuss the pricing and risk management of CDO portfolios. We will focus mainly on the risk management of CDO portfolios. Unfortunately, the risk management of CDO portfolios is an enormous topic in and of itself, and we won't have time to do it justice in this module. However, we will discuss some of the issues that arise. We will discuss some of the weaknesses with the Gaussian Coppola model. We will also mention, as an aside, that linear correlation, the correlation coefficient in and of itself, is not enough to describe the dependent structure of a multivariate distribution. So this fact is lost on many people, and we will emphasize it at the end of this module. Here's an example of a sample synthetic CDO portfolio. Across the top, we've got various columns. So the first column, index, this contains the name, so CDXIGA. This actually refers to a reference portfolio. So this is an index with a certain number of names in the index, and these names are known. Typically there would be 100 names or 125 names in the index. So CDXIGA, IG stands for investment grade. A is typically actually a number. It could be 8, 9, 10, 11 and so on. And different numbers contain different reference portfolios. The second column is just a tranche description. It could be an equity tranche, mezzanine tranche, a senior tranche, or it could be an index. This can be viewed as a tranche with a lower attachment point of 0 and an upper attachment point of 100, as we have here. And the next two columns indeed contain the attachment points, L for lower, U for upper attachment point. We have the maturity. These are 10 years, 7 years, 5 years, 3 years, 4 years, and so on. So the maturities can vary. We have the notional amount. So this is the notional amount of protection that we're buying or selling. And these are the current prices and basis points. Now, these are the spreads, the current market spreads of these tranches. The equity tranche prices are often quoted in a different format to reflect upfront payments and so on, but we're not going to concern ourselves with that. IG, as I said, will refer to investment grade. HY, for example, refers to a high yield, so these will be riskier credits or riskier bonds that are more likely to default. Very often there's substantial overlap in these portfolios. So for example, IGA and IGB, each portfolio or reference portfolio will contain 125 names or 120 names or so on. And in the case of A and B here, typically there will be a very large overlap between the two portfolios. So most of the names in A will also be in portfolio B, and so on. In practice, structured credit portfolios could contain many positions with different reference portfolios, different maturities and counterparties. They also can have different trading formats. So as I said earlier, sometimes these tranches trade in the form of a spread that is paid quarterly, or a premium that is paid quarterly. This is the insurance rate, if you like, for buying protection or buying insurance on the tranche. But sometimes they can also trade in an upfront format and or a running spread format. The ultimate payoff of such a portfolio is very path dependent with substantial idiosyncratic risk. They are very difficult to risk manage. They can also be very expensive to unwind, and that is due to wide bid-offer spreads. Over here, what I'm giving here is a current price, but this should really be interpreted as the midpoint of the bid-offer spread. So the bid and the offer will be on either side of, say, 223. Maybe we'll have 210 and 240. And so if you want to sell protection, you will hit one side of the bid offer spread, and if you want to buy protection, you will hit the other side. So if I'm buying protection, I'm going to have to pay 240 basis points for that protection. If I'm selling protection, I'm going to receive 210. So that's the bid offer. Okay, and sometimes these bid offer spreads can be very wide. So actually unwinding such a portfolio can be very expensive, especially in times of market stress, or when these portfolios, these synthetic CDO tranches, aren't trading very often, as would be the case today. Computing the mark-to-market value of these portfolios can also be very difficult because market prices may be non-transparent. I don't think I've used the phrase mark-to-market yet in this course, but just to be clear, mark-to-market is referring to the current value of a portfolio using current prices in the marketplace. So you're not using the historical price at which you purchased a portfolio of securities. Instead, you're using the current market price for these securities. So that refers to mark-to-market. And on this note, you might be interested in the Belly of the Whale series on the Alphaville blog of the Financial Times. You can actually get to that blog via this link here. And while the Financial Times does have a paywall, so most of the articles aren't available for viewing freely, their blogs are. And so the articles in this series can be found here. This series refers to the so-called London whale. And in fact, the London whale first came to attention because price levels in the CDX IG9 index, so this is an example where we're using a number, so it's the IG9 index, diverged too much from other related price levels. In particular, diverged too much given the CDS prices of the credits in the IG9 portfolio. So you'll see a lot of interesting material in the articles that have been published on this series, on this Alphaville blog. You won't be able to understand everything in this series, and that's in part because there's a lot of jargon and there's a lot of references to positions that we can't see, and indeed there's references to communications that we can't see. Maybe there weren't email communications but verbal communications between some of the players, and so you won't always understand what's going on, but you will see a lot of discussion of value at risk and Gaussian copulas and synthetic CDOs and risk management. By the way, I should have said this at the beginning, but this London whale came to attention because of ultimately massive losses that occurred in the synthetic credit portfolio of the Chief Investment Office of JP Morgan. So this is a very recent situation where they lost several $7 billion out of their Chief Investment Office on synthetic credit portfolios, and reading this series is certainly of interest and certainly relevant to what we've been discussing in these modules. Very briefly, I want to spend a little bit of time talking about copulas. We introduced copula in an earlier module when we discussed the Gaussian copula model, but we haven't had time really to spend on copulas more generally. I'm just going to say a little bit about copulas here and the Gaussian copula model. So certainly the Gaussian copula model is the most famous model for pricing structured credit securities. There has been enormous criticism aimed at this model, and most, if not all of it, is justified. That said, some people like to say that they didn't understand the weaknesses of the Gaussian copula model until after the financial crisis broke. Well, I simply don't think that's true. There's nothing we've learned about the Gaussian copula model that we didn't know before the financial crisis. So to say or to plead ignorance that you didn't understand the model or that the market didn't understand the weaknesses of the model until the crisis blew up or crisis took place simply is not a well-founded statement. Many people fully understand the weaknesses of the Gaussian copula model. Just to mention a couple of them, it's a static model. By static, I mean there are no dynamics in the model. We just compute the expected tranche loss at a fixed period of time. There's no stochastic process here. We assume credit spreads are constant. We assume correlation is constant. We assume correlation is constant across the various names. There are problems with this model in terms of time consistency and so on. So I know this is a very brief aside. We don't have time to go into this in any more detail, but certainly the weaknesses of the Gaussian copula have been well understood. There has been a lot of academic work on building better and more sophisticated models, but none of them are really satisfactory. It's an aside, but I want to also make this point. A common fallacy is that the marginal distributions and correlation matrix are sufficient for describing the joint distribution of a multivariate distribution. In other words, what I'm saying here is many people think that if you've got a multivariate distribution, the only thing that you need to know about distribution are the marginals and the correlation between the random variables. Well, that's not true. Correlation only measures linear dependence, and the next slide will provide a counterexample to this. So in this slide, we've got two distributions, two bivariate distributions. The first one is a bivariate normal distribution, and the second one is what's called a meta-Gumbel distribution. What I want to emphasize here is that in each case, the marginals are standard normal. So the marginals in each of these are standard normal. Now the plots aren't really drawn to an appropriate scale. Maybe we should stretch the x-axis out here, because really the width, the length of the horizontal piece here should be the same length as the vertical piece here. So they're both, the marginals in all cases are in 0, 1. The correlation in each case is 0.7. So what we have here are two bivariate distributions which have the same marginals and the same correlation, but they're very different. So we can see that the large joint moves are much more common to occur in the Maida-Gumbel distribution than they are in the multivariate normal distribution. And the way to see that is to look for moves where the x and y variable are both greater than or equal to 3. These are up here and up here. So over in the multivariate normal, we see there's only one move where both the x and y variable are both greater than or equal to 3. Whereas over here, we see there are 5 such situations. What we've done here, by the way, is we've simulated 5,000 points from each of these distributions. So 5 of those 5,000 points, so 0.1% of those 5,000 points resulted in an extreme joint move, whereas only 1/5 of that resulted in an extreme joint move in the case of the bivariate normal. Now 0.1% might seem like a very small number, and indeed it is. But when it comes to figuring out losses on equity tranches and so on, that 0.1% can be substantial. And so the point I just want to make here is that copulas, by the way, the usage of copulas actually, by the way, the usage of copulas in financial engineering actually originates in insurance mathematics. So this is an example where a technology, a mathematical modeling technology, copulas, was actually borrowed from the insurance world, from the insurance mathematics world, and taken into the financial world and used to price structured credit products, including CDO tranches and nth to default swaps, which we haven't discussed at all. But the point I'm trying to make is that these copulas encompass all the information about joint distributions, and correlation isn't enough to do that. And one criticism of the Gaussian copula model is that it results in joint moves that occur too infrequently. We don't see frequent enough joint moves, and that might have an impact as well for super senior tranches, which are only hit when lots of defaults occur together, and the losses in the portfolio get above the lower attachment point for the super senior tranche. I can't get into much detail as I would like to, but this here just gives you a brief flavor of copulas and how correlation does not capture the dependence of multivariate distributions. Correlation only captures the linear dependence of multivariate distributions. The copula, the idea of a copula, captures all of the dependence in a multivariate distribution. In this module, we're going to go beyond CDOs and discuss more complicated products such as CDO squareds and CDO cubed, and maybe even a little bit about ABS CDOs as well. The point we're going to try and make here is that the risk management of these products is incredibly difficult, and it is difficult indeed to see any economic justification for introducing these products. Nonetheless, they were traded in the marketplace in the lead up to the financial crisis, and it is worthwhile seeing what they were and how they actually work. It should already be clear that structured credit portfolios consisting of CDO tranches can be difficult to risk manage, but at least there's a solid risk-sharing motivation for the creation of CDOs, and this is true for securitization in general. We mentioned earlier that the idea behind securitization is to package a series of underlying bonds or loans or whatever into a set of new securities, each of which may have a different risk profile and which may appeal to a different audience or investor class, if you like. And so by spreading risk that way, we can actually make the financial markets more efficient. And so this is the theory that justifies securitization in general. But the structured credit market quickly ran amok with the creation and trading of ever more complex securities. For example, products such as CDO squareds were soon developed. They were difficult to justify economically. They provided great examples of product risk, whereby people didn't really understand the product that they were buying, model risk, in that really models were completely inadequate for pricing these securities, legal risk and so on. Why legal risk? Well, the actual contracts underlying these CDOs ran to maybe many thousands of pages, and so it's hard to believe that anybody fully understood what exactly they were purchasing when they invested in CDO squares and so on. Before discussing these classes of securities, these CDO squareds, recall first how a CDO is constructed. So we've got an underlying pool of bonds, say 125 bonds. We might have what's called, as we mentioned earlier, a special purpose vehicle, which is a legal entity into which we would place these bonds, and then from these bonds we can construct the CDO. So the bonds form the underlying collateral for the CDO, and then the CDO is tranched up into an equity, mezzanine, and so on tranches, and people can invest in these different tranches and get very different risk profiles as a result. So that's how a CDO is constructed. How about a CDO squared? Well, here's an example of a CDO squared. We're going to assume that we've got 100 CDOs, CDO number 1 up to CDO number 100. We're going to take the mezzanine piece of each of these CDOs. So we're going to assume the mezzanine piece corresponds to attachment points of 3% up to 7%. And then we're actually going to construct a CDO squared using these mezzanine pieces. So the CDO squared is constructed from mezzanine tranches of underlying CDOs. So basically you can think of these mezzanine pieces as now corresponding to the bonds underlying the CDOs. So basically a loss will only occur in, say, the equity tranche here when there is at least some loss in the mezzanine tranche of one of these underlying CDOs. If none of these underlying CDOs ever experience a loss in their mezzanine tranches, then there will never be a loss anywhere in the CDO squared, and in particular in the equity tranche here. On the other hand, if all of these mezzanine tranches experience losses, in fact, if all of them are blown out, in other words, maybe losses go right through the mezzanine tranche in all of these tranches, well then the CDO squared will face complete wipeout as well, all the way up through the equity, mezzanine and senior tranches. Remember, the mezzanine tranches are the underlying bonds, if you will, for this CDO squared. It's also worth pointing out that many bonds act as collateral for multiple CDOs. So behind this, remember, there are bonds behind each of these CDOs, and in many cases what you'll have is you'll have a bond being in the reference portfolio for this CDO, but it might also be in the reference portfolio down here for this CDO. So there will be a lot of overlaps of names of bonds going into these different CDOs. So this is just repeating in words what we showed visually on the previous slide. There's not much else to say here, so let's move on. Here's the question: how would you price and risk manage a CDO squared? Here are some considerations. And by the way, a discussion of CDO squared can also be found in that paper by Donnelly and Embrechts that I referred to in an earlier module. They discuss some of these issues there as well. So here's some considerations. The legal contract governing each of the mezzanine tranches in the underlying portfolio of CDOs could be on the order of 150 pages long. So therefore, if you really want to do your due diligence, really understand the legal details underlying a CDO squared, you would need to read approximately 100 times 150, which is 15,000 pages of legal documents, to which I say good luck. You should also, of course, read the contract governing the CDO squared. How would you keep track of the CDO squared's performance? Just to keep track of the performance of the CDO squared, remember, you're going to have to keep track of the performance of all of these underlying bonds. You're going to have to feed the performance of these underlying bonds into each of these 100 CDOs and figure out what's going on in each of these CDOs. And then based on that, you're going to have to figure out what's going on in the CDO squared. In order to do that, you're probably going to have to write several thousand lines of computer code. And that is just to keep track of the actual performance. It is not to actually price the CDO squared or to risk manage the CDO squared. You might need a model to price it. In fact, it's hard to say that any model really could ever possibly price that CDO squared correctly or give you a good sense of how much a fair value is for a CDO squared. So these are very difficult securities to manage. How would you perform scenario analysis? How would you estimate the value at risk or the conditional value at risk of a portfolio of CDO squareds? It seems very difficult to even imagine doing such analysis. But why stop there? There are also ABS CDOs. An ABS CDO is a CDO where the underlying securities, or the underlying bonds, are themselves asset-backed securities. So going back to our CDO squared, instead of having a CDO number 1 up to CDO number 100, this could be ABS number 1 up to ABS number 100. And these ABSs could in fact be mortgage-backed securities. So there would be underlying pools of loans feeding into these ABSs, which then feed into the CDO itself. You can have CDO cubes. And why stop there? So here's how a CDO cubed would work. You've got your n CDOs, and a couple of slides ago we had n equal to 100. Now we've got n CDOs. From that we construct, say, 100 CDO squared. So I'm imagining here that the number n is greater than 100. So we can construct CDO squared out of these n CDOs, maybe using the mezzanine tranches from these CDOs. Now we have our CDO squares. Let's take the mezzanine tranches of these CDO squared and construct another CDO. That would give us a CDO cubed. So if your head is spinning at this point, it's not surprising. And yet there were trades apparently on CDO cubed in the marketplace leading up to the financial crisis. So one other point I'll make about the financial crisis and the subprime crisis before ending this module is the following. So there were securities, I mentioned them on the previous slide, called ABS CDOs. And very often actually it was subprime mortgage ABSs that were feeding into these CDOs. And so you can imagine this being the CDO. Maybe there's equity, mezzanine, and so on. So maybe this is the 0 to 3% tranche. Maybe this is, I don't know, a 6 to 9% tranche. And maybe the underlying pool of securities that feeds into this CDO are some mortgage-backed securities. So we've got a bunch of mortgage-backed securities feeding in here. Well, an interesting anecdote about the financial crisis is that the subprime crisis actually didn't come suddenly to many people. There were many market players, including banks and so on, who had a good sense that the subprime crisis was coming down the line. And one way to profit from that belief was to actually buy protection on the 0 to 3% tranche of an ABS CDO. So if you buy protection here, what will happen is that you're going to get paid off, you're going to make money if you see lots of defaults in the 0 to 3% piece, or lots of losses in the 0 to 3% piece of this CDO. And if you expect the subprime crisis to come down the line, then you're going to assume that the underlying mortgage-backed securities are indeed going to see a lot of losses because people are defaulting on their loans and so on. And if they're defaulting on their loans and you're seeing losses in the underlying mortgage pool, then you expect to see losses inside this tranche as well. And so you could profit from that by buying insurance on this tranche. And so that's what some players did. They bought insurance on this tranche. But when you buy insurance, you've got to pay an insurance premium. And the insurance premium, which you have to pay quarterly, could be quite substantial. So rather than having to pay out this amount of money every quarter, some of these players or banks got clever and said, you know what? Instead of paying out money every quarter on this tranche, why don't we sell protection or sell insurance up here on this tranche, say. And if you sell insurance on this tranche, well, then you're going to be taking in a premium. And you could use the premium you take in here to fund the insurance premium you have to pay out for your protection here. The only problem with that is because this tranche is much riskier than this tranche, you have to sell a lot more insurance up here to cover your payments down here. And that's what some players did. They thought that the subprime crisis might blow through these tranches up to here, say, but that the higher tranches would be safe and that they would never incur losses and so on. And so they thought it would be a good idea to sell protection on these more senior tranches and use the premium to fund protection on the equity tranche. And so that was a good idea. It meant you didn't have to spend any money net on your position. The premium here was funded by the premium you were taking in up here. The problem was that the subprime crisis came along and was much more severe than anybody anticipated. And in fact, the losses didn't stop at this point, or at least the mark-to-market losses didn't stop at this point. The mark-to-market losses went like this and blew out these tranches as well. And so the players who actually put on this trade ended up losing an awful lot of money because they were selling protection on a much larger notional up here than the notional they were buying protection on down here. So this is just an aside, and the reason I wanted to mention it is, number one, many players actually did see the subprime crisis coming along, and they used these ABS CDOs in order to make plays on what was happening or what might happen with the subprime crisis. But also it emphasizes how even if your opinion is correct, and their opinion was correct, the subprime crisis was coming and it did occur, it can still be very difficult to execute a trade properly. So they executed the trade by buying protection down here, selling protection up here, but their execution didn't work. In fact, the subprime crisis was worse than what they anticipated, and some of these players ended up losing an awful lot of money as a result.
In this module, we are going to discuss real options. These are options that are written on non-financial, more operational units, and they have optionality built into it, meaning that we have the option of doing one particular set of operations or another set of operations, and we want to use option theory to value an operation with built-in options. In this set of modules, we're going to talk about how option theory can be used to evaluate non-financial investment and decision problems. Some examples of this include the valuation of a lease on a gold mine. We're going to go through this in detail. Valuation of an equipment upgrade option, also in the context of gold mine. We'll go through a detailed example of how one could use option theory for calculating the value of such an option. Valuation of a drug development process. This could include options such that you could sell your IP to another company, or options such that you can increase the investment into a particular drug process, and so on. Evaluation of a manufacturing firm that has the option of contracting its facilities to other manufacturers. The option here is to decide when to contract out your facilities and how much of it to contract out. Depending upon the market conditions, you could do that. And in order to figure out what the value of such a manufacturing firm is, one has to accurately describe the value of such an option. And we know that in order to calculate the value of an option, we have to find a discounted expected value according to the risk neutral measure. So one can apply that technique to value a manufacturing firm. We'll go through simple examples of valuation of a tolling contract of a power plant, valuation of a gas storage facilities, and so on. The real options paradigm wants to view a project as having many sources of uncertainty. These could include market uncertainties such as price for the product, demand for the product, industry uncertainties such as mergers and acquisitions happening, innovations happening in the industry, technical uncertainties such as research and development, when a particular research breakthrough will happen, how will the development progress happen, and so on. Organizational uncertainties, key personnel might leave the company and what should the company do to react to it. Political uncertainties, meaning there are regulatory changes, there could be wars, there could be government changes, and so on. The real options paradigm wants to manage these uncertainties by adding flexibility to a project or to a company via options. And project management in this paradigm is all about managing flexibility. So we will explore some simple examples of real options in these modules and get back to this idea of how to introduce flexibility, how to value the flexibility, how to optimally execute these flexibility, and so on. The example we'll be using is called the Simplico gold mine case. This is example 12.7 from Investment Science in Leuenberger. The setup of the problem is as follows. We want to evaluate the value of a 10-year lease on a gold mine. The details are as follows. The price of gold, the current price of gold is $400 per ounce, much lower than what the current prices are right now. Each year, the price increases by a factor U, which is equal to 1.2 with probability P equal to 0.75, or decreases by a factor D equals 0.9 with probability 1 minus P equal to 0.25. The cost of extracting gold is $200 per ounce. The maximum rate of gold extraction is 10,000 ounces per year. The interest rate, R, is 10%. So given the interest rate and given U and D above, we can compute the risk neutral probability Q, and that turns out to be 2/3. When we are doing this risk neutral probability, we are implicitly assuming that we can buy and short sell gold. We're going to use a convention that the cash flow occurs at the end of the year. The revenue is determined by the price at the beginning of the year, but this revenue appears at the end of the year for bookkeeping purposes. So here are some details of the modeling. The current time t is equal to 0. The lease ends at t equal to 10. At the beginning of the 10th year, we have to return the mine back to the owners, and therefore the lease ends. The states in each year is given by the gold prices at the beginning of the year. Let VTS denote the value in state S at the beginning of the year T. This is the value of the lease in state S at the beginning of the year T. Since the lease ends in 10 years, we know that V10S is equal to 0. Now we want to compute VTS as a recursion. So here's my time T. I'm sitting in a particular state S, and this state S is determined by the price of gold in that particular year. From this state, I can go to two possible states, U times S or D times S. The probability of going to U times S is Q, the risk-neutral probability, and the risk-neutral probability of going to D times S is 1 minus Q. I already know the value here, so I know VT plus 1 US because I'm doing a recursion backwards. And similarly, I know VT plus 1 DS, and I want to compute what is going to happen. I want to compute VTS. And the recursion is very simple. You take the revenue in year T plus the expected value that you would get starting from time T plus 1 and onwards and discount it back by a factor 1 plus R. The reason the revenue is also being discounted by a factor 1 plus R is because we assume that the revenue occurs at the end of the year, and therefore it has to be discounted back by the annual interest rate R. The revenue in year T can be written very simply to be the maximum of S minus C and 0 times the maximum rate at which you can produce gold, which is G. What does this mean? If the current price of gold is greater than the cost of extracting gold, so S minus C is strictly positive, then you will extract gold at the maximum possible rate. If S minus C is equal to 0 or less than 0, then you will not operate the mine. So implicitly, we are assuming that there is no cost for shutting down operations in any given year. We can shut it down in 1 year and reopen the mine the next year, and we don't pay any cost for that. Since we are interested in pricing this lease, all the expectations must be with respect to the risk-neutral measure or the risk-neutral probability. And that's why we are highlighting the fact that here the expectation is with respect to the risk-neutral probability. Written out in detail, this is Q times the value at the up state plus 1 minus Q times the value of the down state. We know the value at time 10. We can compute it backwards using lattice to compute V0 of S, which is the value of the lease at time 0. In the next module, I'm going to work through this in an Excel spreadsheet and show you exactly how this works out. Now we want to take this example a little bit further. If you think about this example for a moment, it is actually a sequence of options. We don't do it in that way. We don't compute it explicitly in that manner, but it is a sequence of options. At the beginning of every year, I can look at the price of gold and decide I have the option to either run the gold mine or not run the gold mine. So in every year, I have the option of running the gold mine or not running the gold mine. And that option has been implicitly calculated here. It's a maximum of S minus C and 0. I can choose which one I want to opt for at the beginning of every year. In the next example, we will explicitly include another option and then try to value it. So this is an example with an equipment enhancement option. The details of the equipment upgrade are as follows. The cost of the upgrade is $4 million. It's a one-time fixed cost. If you upgrade the equipment, the new rate of production goes up to 12,500 ounces per year instead of 10,000 ounces per year. But at the same time, the cost of production goes up to $240 per ounce instead of $200 per ounce that it existed before. This upgrade is an option in that it can be exercised at any time over the lease period, but once the upgrade is in place, it applies for all future years. When the lease ends, the upgraded equipment reverts back to the mine owners. And the question is, what is the value of this upgrade option? So we're going to solve this in stages. First thing we're going to define is a value function with the upgrade in place. So V up will denote a value function, the value of the mine in state S at time t with the equipment upgrade already in place. We can compute this using the same computations as we did for Vs, except that now we have to use these new parameters G up and C up in order to calculate out what V up is. Now, this is the value that you would get if the upgrade was already in place. But now you have to pay for the upgrade, and how does one model it? The upgrade is an American option that pays V up S minus 4 million if exercised in state S on date T. We haven't upgraded the equipment yet. We're sitting in a situation where the mine is operating, but the equipment upgrade has not happened. If I decide to upgrade, I'll move to a different mine operating conditions. At that particular time, so here's my state S. If I decide to upgrade, my value that I will get will be V up TS now in this particular state. But in order to upgrade, I will have to pay $4 million. So you end up getting $4 million as the cost that you pay for this upgrade. Once exercised, the equipment is upgraded and the mine is operating according to the policy corresponding to V up T, meaning that if we decide to operate a mine in V up T, we operate the mine once the equipment is placed. If we decide in a particular year the cost of extracting gold is too high, we don't operate the mine, and so on. So let UTS define the value in state S and date T with an upgrade option. This time, the equipment upgrade has not happened. We only have the option of upgrading the equipment. So what do? In every state and every time, you have two actions available to you. Either you exercise the option or you don't exercise the option and you continue. If you exercise the option, the process stops. You move to the lattice that corresponds to the upgraded mine. You pay $4 million for it, and then you manage the mine as if the equipment upgrade was already in place. So that's the exercising option. If you continue, then you have not upgraded. Your cost of producing gold still remains at 200. Your maximum rate at which you can produce gold still remains as 10,000. And this recursion is just as if you were continuing with old equipment. And the decision now is which of these two actions to choose, whether to upgrade or to continue. And we will show you in an Excel spreadsheet how these calculations are done. In this module, we'll go through the Simplico gold mine example that we introduced in the video modules. The first half of this module is about the operating option, meaning that the only thing that I'm trying to value is a lease over 10 periods, and every year I have the option of either shutting down the mine or operating it at the maximum possible rate. In the next half of this module, we're going to value an equipment upgrade option that is also valid over the 10 years. We're trying to figure out when we will exercise it and what is the net revenue gain that I would get from that option. So here are the details of the model. The current price of gold is $400 per ounce. It can go up by a factor of 1.2 or go down with a factor of 0.9. The interest rate is 10%, and therefore from there I can calculate out what the risk neutral probability of the up state is and the risk neutral probability of the down state is. So that's going to be Q and 1 minus Q, respectively. The extraction rate and cost are as follows. The cost is $200 per ounce. The extraction rate is 10,000 ounces per year. So in order to decide when to operate this plant and when to shut it down, I need to have a lattice of gold. Whenever the gold price is greater than $200, I'm going to operate the plant, and I'm going to operate it at 10,000 ounces per year. Whenever the price of gold is below $200, I'm going to shut it down and not incur any costs. Here's the gold lattice. It starts with $400. It goes up to $480 or goes down to $360 and so on. These are in thousands of dollars per ounce. Down here, you will see states where the price of gold is lower than the $200 required to extract gold, and therefore in these states we are going to exercise the option of shutting down the mine and incurring no cost. In all the other states where the price of gold is greater than $200, we're going to exercise the option of operating the plant and getting the profits that we get from it. So here is the value of the gold mine lease in millions of dollars. At the beginning of the 10th year, we return the gold mine back to the owners, and therefore the value at the beginning of the 10th year from the future is going to be zero. Now we start looking at what is going to happen to a state before. So if we look at a particular state over here, all we are trying to do is we are using the formula that we had developed in the video modules. If I decide to operate the gold mine, I'm going to get K19 minus cost, which is the price at the current point minus cost times the maximum possible rate. But if this term, K19 minus cost, the current price minus the cost of operating the mine happens to be less than zero, I will elect not to run the mine. I will exercise the option of shutting it down and get a zero from this term. So this max of K19 minus cost and zero times the rate tells you what is the 1 year revenue from operating the mine in the optimal fashion. And that might include shutting it down. This next term, Q times offset K33 minus 11 and 1 minus Q times offset K3301 basically computes what is the expected value from the future. It's Q times the value in the up state plus 1 minus Q times the value in the down state at time t plus 1. And all of it is divided by 1 plus the interest rate to bring it down to current dollar terms. So same thing is being done over here. At previous times is exactly the same thing, and at the end of the day you end up getting that the value of this option turns out to be $24.07 million. That is the total value that you could generate from leasing this mine. That's the fair price for the mine under the circumstances that we are considering. Now let's go on to consider the case with an equipment option in place. So the story is the same. The gold price dynamics remain the same. You've got $400 per ounce today. They go up by a factor 1.2, go down by a factor 0.9, and the risk neutral probability is 0.6. The interest rate is 10%. This lattice is exactly the same as it was in the previous page. So now what we want to do is figure out what is the value of an option that allows us to upgrade the equipment anytime between time 0, which is now, and time 10 when I return the mine back to its owners. As we detailed in the video module, in order to compute this, I want to think of it as an American option on two different mines. So I've got the mine which is operating as it does currently with $200 per ounce as the operating cost, $10,000 as the maximum extraction rate. At any given time, I can exercise my upgrade option and move to another mine, which has $240 per ounce as the operating cost, but $12,500 as the maximum possible rate. In order to do this, we showed in the video modules, I have to first calculate out the value of a gold mine with the equipment option already in place. And that's what I'm doing over here. This is the value of a gold mine lease with the cost equal to $240 and the rate equal to $12,500. This is the value where the equipment upgrade has already happened. Again, the calculation is the same as before. You start with all zeros and then you back calculate. You back calculate as K16, which is the cost of gold or price of gold, minus the cost of operation, which in this case is $240, times the maximum rate, which is $12,500. And Q times the up state plus 1 minus Q, the time state, divided by the interest rate, which is 1 plus the interest rate. Calculate it backwards, and you end up getting various values of the various states in this particular lattice. Now we want to value what happens to the gold mine with an equipment option in place. You start off with zeros here. In the beginning of the 10th year, you have to give the gold mine back, whether you upgraded the equipment or not, and therefore the value that you end up getting is 0. Now let's see what happens to this particular state. It's a complicated formula, so let's go through it one by one. There are two different maxes. There is one term over here. So this term is the same expression that we had for figuring out what to do with a gold mine where the operating cost was 200 and the operating rate, the maximum rate at which you could extract gold, was 10,000. So this particular maximum, all it's saying is that if I continue to use the current mine, meaning not upgrade, then I still have to decide whether I would operate the mine or not, and that corresponds to the max of K16 minus 200 in 0, and if I decide to operate, I'm going to run it at the maximum possible rate. And then I need to figure out what will happen in the future. The second term over here, this maximum, refers to the fact that now I have the option of moving from this lattice point to the lattice that corresponds to an upgraded mine. So instead of staying on this lattice, I'll move to the upper lattice. But in order to move to the upper lattice, I have to pay a cost of $4 million. So K35 is the value that I would get in this upgraded lattice, which is 20.73. But I have to pay $4 million for it, and therefore I have to decide whether it's worth it. If you look at what happened over here, the value here is 20.73, the value here is 16.94. If I had decided to upgrade, I would have got 20.73 minus $4 million, which is 16.73. In this particular state, I can get $16.94 million simply by continuing. So it's worth it for me to continue and not pay the extra $4 million. Same thing, we go backwards, calculate out exactly the same calculations over here. What is the maximum profit that I could get by continuing with my current mine operations, or I can upgrade by paying $1 million. The value here is 29.88, which is 33.88 minus 4, so it appears that at least in this particular state, we will jump up. And in a little bit, I'm going to show you how exactly the exercise boundary is going to be calculated. We calculate this backwards, starting from 10 all the way down to time 1. And at time 1, we get, or time 0, which is the initial state, we end up getting that the value of the gold mine with the equipment option in place is $24.63 million. And if you compare this to the lease without the equipment option, it's $24.07 million. So it turns out that it is having that option, that equipment option is valuable. And the value of that is approximately $0.6 million. The thing to think about is that we can consider two different situations. One situation where we have the option in place, and another situation where we are forced to upgrade at time 0. If we are forced to upgrade at time 0, we will get $27.02 million, which is the value that I get with the upgraded mine, minus $4 million. So I would only get $23.02 million. Whereas with an option in hand, I can get $24.63 million. And the difference between these two comes from the fact that with an option, I have the flexibility of when I exercise the option. So it will turn out that at various states when the price of gold is high, and therefore I expect to make a lot of profit, it makes sense for me to pay the extra operating cost of $40 per ounce in order to get the extra rate of extraction, which is 2,500 more. So in order to decide where we are going to extract, we just compute the two value functions. So if you look at a generic one over here, what we are doing is we are looking at the value function of exercising my option versus the value function of continuing. If the difference between them is positive, I'm going to exercise. If the difference between them is negative, I'm going to not exercise. Negative or 0, I won't exercise. So if you calculate this out, you end up getting an exercise frontier, which is the states at which you're going to exercise.